The consumer is starting to say that these prices are becoming, somewhat problematic.
The consumer has softened a little bit, which makes some sense given all the pressures that are out there.
The one thing that's maybe causing people to go home are these whiffs of stagflation that we keep seeing.
The biggest tail risk is inflation, and if inflation spikes higher, that's the big risk.
The CPI data, I think, are going to show this continued trend that disinflation has stalled.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The week begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance coming into Wednesday with the Nasdaq at all-time highs and the S&P 500 not too far behind. Equity futures this morning just about positive. Your lineup at 8:30 Eastern Time looks a little something like this. CPI data in America alongside US retail sales, and then the Hawks come out. Neil Kashkari, Mickey Bowman, with a lot to say, Lisa, I'm sure, about this inflation backdrop.
And if this Fed official and Fed Chair Powell really want to give some sort of hawkish message, this market is not listening. This is a market that wants to rally on a disinflationary pivot, regardless of the data that it gets. Even though you had Fed Chair Powell yesterday come out and say he is less confident in the disinflation narrative, still we're seeing near all-time highs and a massive rally in bonds.
There seems to be some confidence on Wall Street. The consensus is absolutely overwhelming. I was going through the estimates this morning. 68 estimates go into the Bloomberg survey. 63 of them have put down 0.3% for core CPI. The consensus is there for all to see.
It is there for all to see, Jonathan, but then we also have retail sales, which a lot of people are saying actually might be more important, because if we get 3 point whatever it is on CPI, the Fed needs to see consistency in that data, months of that. But retail sales, potentially, if they come in softer, and we have seen consumer sentiment starting to drift lower, if retail sales come in softer, potentially that is one piece of data that shows maybe at some point the Fed will be ready to make that cut.
I'm pleased you brought that up, because we've had some contradictory signals for the US consumer. I was catching up with Brian Moynihan a little bit earlier this week over at Bank of America. His view's pretty clear. Consumer still looks pretty resilient. If you look at the balances of some of the consumers in America, still pretty high, particularly relative to the 2019 average. You listen to how the consumer feels, and it sounds pretty dreadful. So which one is it?
We're talking about the consumer as though it's a monolith. I think that Bank of America had a average FICO score on its credit card for portfolio of something like north of 700. So this isn't exactly the average consumer. It raises a question, which consumer are we talking about? Is it the lower income, or is it just sort of some of the people who have savings and have the ability to spend? Right now, it is clear people are feeling inflation, but on the other hand, you're still seeing sales come in strong in a lot of different places.
Retail, a massive focus this week. Live from New York, welcome to the programme if you are just joining us. Let's kick it off with the price action. The scores on the S&P 500 shaping up as follows. On the S&P, we are just about positive. Yields are a little bit lower. We're down 2 basis points of 4.4179 on a 10-year. In foreign exchange, just reclaiming 108 on a euro, 108.28. We're positive there by 0.1%. Coming up in the next 60 minutes, we'll catch up with George Goncalves of MUFG as investors await the latest CPI print. We'll speak to John Lieber of Eurasia Group on new tariffs against China, and Virginie Maisonneuve of Allianz on the global equity market outlook. We begin with our top story. Global stocks rallying as investors await CPI and retail sales data at 8:30 Eastern Time. George Goncalves of MUFG saying this: we think there is a risk of seeing a rounded up 0.3 core reading, which would be music to the ears of most market participants. Yet, as with all releases, watch the details. George joins us now to talk about the details. George, what detail, what element of this print are you focused on?
Look, so we had a lot of one-off factors in Q1, as you know, and good morning. Look, there's a big debate on Wall Street, and look at the price action. As you kind of recapped that at the start, the market's pretty confident. The market's both the rates market as well as equity markets are confident this number is going to be either in line or maybe softer. And if we get a softer number, as I kind of quoted there, yeah, we would probably see a market that would keep running here, especially like rates. Rates feel like they want to rally, and I think it comes down to really owner's equivalent rent. We've had two issues, right? We had a really strong jobs market, or at least the headlines seem very strong. In the last reading, we got a weaker print, and then now we have Wall Street kind of considering maybe the jobs market is not as strong under the surface. What if you get the same sort of outcome with inflation? Q1 was a one-off, And if we get, this April reading coming in softer, led by what's been the biggest lagging factor, which has been owner's equivalent rent, if that really comes in, that can really help out the inflation readings.
George, let's stick on CPI then and the market reaction to it and build on what you just said. I think we're all familiar with how we'll respond to a downside surprise. I think less familiar with how we'll respond to an upside surprise more recently because of the Fed's reluctance to hike. If you'd asked me that question a few months ago, I would have told you what markets are going to do. Then everyone started talking about asymmetric risk. What are your thoughts on that today, George? Are we reaching the limits of taking comfort in the Fed's reluctance to hike? Would we just look at this as bad news at 8:30 if we get another upside surprise?
Look, it depends on the upside surprise and the magnitude and the composition, as you know. The market is as I said, very confident going into this number. If we get any sort of deviation to the upside, I don't think it brings back the idea of hiking, but it takes off the cuts, it pushes them back further. And, again, we have the 10-year under like 450. It can quickly go back above 450. And the 2-year, really, that's the one to watch. You can get a move towards 5%. Remember, the last few big upside surprises, we've seen like 15, 20 basis points move on a day. So rates can get really volatile today if we get an upside surprise.
If we get a downside surprise, George, but we also get a significant downside surprise in the retail sales, how do markets respond given the fact that on the edges there are some people who are worried that maybe, and I'm sorry to do this, bad news is bad news?
I think I agree with that, but you can easily get spun around too because both numbers come out at the same time as 8:30, as you know. So this could be very tricky navigating the back and forth between how good or bad inflation was and is retail sales really kind of coming under pressure here. You could get the opposite, right? You can get retail sales, and depending on the way the readings come through, maybe just kind of a in line or maybe better number and inflation weaker. So I think we're going to have to just kind of judge it at 8:30.
We've been talking about how there has been this pivot party. It was put on pause for a hot second, and then it came back as people saw that Jay Powell really did seem to want to cut and take rate hikes off the table. It seems like Powell's trying to push back a little bit, saying that it's going to take him a lot longer to feel confident, saying that they have been surprised by how hot the data has come in for the first quarter of this year. They've been disappointed. Do you think he can't put this genie back in the bottle? That basically this market's moved on, they've heard the dovishness, and they're not going to go back?
They've managed to do that a number of times. And as you mentioned at the beginning, there are hawkish speakers later on in the day. So if we get a market that overreacts to a softer inflation reading, I'm sure the various Fed speakers will try to at least kind of instill the idea that they're not rushing to cut. But yes, I do think that the genie's out of the bottle, and you've done it twice. You've done it in December, and they got the market excited. Then you did it again in May. And you also adjusted QT. Therefore, the market's looking for any sort of signs of economic weakness to justify earlier cuts.
George, you're also looking into the weaker expected jobs report. You see some cracks in the labor market. Can you walk us through what you're seeing?
I think it's a whole host of features. It's just the early warning signals around temp workers, part-time workers versus full-time workers. There's a whole litany of sort of kind of cracks that are there. If you start looking at the actual annual growth rates of full-time, part-time, the multiple job holders. There's a reason why the consumer, sentiment keeps coming in weaker with stocks at the highs and apparently unemployment rate low. The consumer is feeling pressure both from inflation, the lack of wage, kind of increases, and worried about the jobs outlook. And I think that is starting to kind of resonate. And I think that we're seeing layoffs too, right? Actual physical layoffs. So I do think the cracks are there. And this is why I've been more of a dovish leaning that the Fed should be prophylactic and get ahead of the curve and start to actually cut. I'm probably one of the standouts with a July cut, but I think a lot can change in the next 2 months.
You're certainly not on the same page as Governor Mickey Bowman over at the Federal Reserve, who has no cuts for 2024. And let's be clear, she's not alone. Lisa was catching up with Torsten Slok of Apollo recently. He's got the same call. This consumer story, George, is really interesting. From the equity market's perspective, it's a big conversation, whether you want staples or discretionary. Can you run us through the bond market call now? What exactly are you and the team advocating for?
Yeah, look, so we like buying dips in the front end. The front end makes a lot of sense. However, if we were to get a more protracted weakness on the economic data, we got to be careful about bull flatteners into the summer. Of course, we have an election cycle still ahead of us. There's a lot that the markets are going to contemplate. And I think that the consumer is the key focus here. Lisa mentioned that this kind of idea, we can't think about it as a monolithic entity. I mean, the U.S. consumer, in many ways, to me, reminds me of emerging markets. And this is going to sound strange by saying so, but the U.S. consumer will shop until it drops. It'll spend, it'll go on credit. But once it loses access to credit and liquidity, it's the same thing like an emerging market having a sudden stop of capital inflow. The consumer will just grind to a halt, and that can easily happen over the summer. And that's going to really trouble the Fed.
George, some of the moves at the front end of the curve have had an EM-like feel to it as well. It's only a month ago that we had a hot CPI print and a double-digit move on a two-year yield. We were higher by the end of that session by more than 20 basis points and threatening to break 5% all over again. Do you think that kind of price action is in the rearview mirror?
No, I think that rate volatility will be with us until the Fed actually makes a decision on when they're going to start to normalize. And that's the whole idea of like starting early, being preventative, own the narrative on the rate cuts and say it's normalization. The further control you have about that, and the more you deny and you push it back, you're just going to have to do bigger cuts later on.
Which raises this question of how much higher the chances of a hard landing are, or a harder landing. Something akin to a true recession is the longer that the Fed sticks with holding things higher for longer. How are you gaming that out?
Look, I think you need to have a probability framework. You have to think through the consumer and the slowdown there takes time to show up. It's more about if we get a catalyst that comes from left field that would then really trigger financial conditions tightening and markets going down. Like, let's be honest. So I think that the natural kind of econ 101 grinding lower, consumer has floating rate risk in auto loans and credit cards and other loans. And again, this compositional issue is really important. Those that are really paying these high interests probably don't own homes and don't have really a linkage back to financial wealth. So I do think that the consumer's under pressure. That's a really slow kind of burning economic drag. But if we were to get a shock in between then that would be the catalyst.
George, before we let you go, yesterday, John, when he sat down with David Sullivan, or 2 days ago, of Goldman Sachs, he talked a lot about the deficit. We're hearing from Jamie Dimon, very worried about the deficit. I hosted a panel on the deficit, and people tried to figure out how much to worry about that. How do you think about that in terms of when it becomes a market event, given the fact that right now the dynamics all have to do with the things we're talking about, which is CPI, which is growth?
Look, and as we've seen supersized Treasury auctions. They create their own demand. They create their own liquidity. But the more we do this and the more we increase our deficits and our debt, it starts to crowd out credit. And this is why that's really where it matters most. And at some point, we'll force the banks to start buying treasuries again. And that's something that I think we should avoid and really go back to more kind of credit creation at the private sector level.
George, let's just get to that just quickly. Is there any sign of that happening? Crowding out credit, given the amount of supply we've had so far this year and the amount of demand that's met it?
Well, look, on the IG and then on the capital market side, no. I mean, there's obviously that has its own sort of buyer base as well, and so and there's been a high focus on credit in general. But it's just it's kind of constant. You keep doing it over time, it starts to compete, and I think that's where we're getting at. And it doesn't require, by the way, super high rates. It just means that there's a lot more treasuries that have to be taken down relative to other bonds.
George, thank you, sir. George Goncalves there of MUFG, looking ahead to that data later this morning. About 2 hours and 15 minutes away. US CPI and US retail sales, and now every single time we talk about the deficit, I think of one man, Steve Eisman, sitting here just last week saying, oi, the deficit.
Yeah.
The oi, the deficit people have been saying the same thing for the best part of 40 years.
It hasn't become a market event, and if you're early, you're wrong, and that's basically what he's been saying. So I did this panel on this, and honestly, it was fascinating because people in the government were saying this is a huge problem. Look at these projections. They're going to the moon, and it is on paper. But if you look forward, what's going to actually trigger it? Michael Ferroli of JPMorgan said something fascinating. So the biggest problem is the size of the Treasury market is getting too big for primary dealers, and that he's concerned about something breaking or primary dealers not being able to absorb some of the flow. These are the ways people are looking at it, but otherwise, it's not really showing up.
Much more to come on that story. Equity futures just about unchanged on the S&P 500. With an update on stories elsewhere this morning, here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China is considering buying unsold homes to support its troubled property market. That, according to people familiar. The State Council is currently seeking feedback on the plan. It would involve state-owned enterprises buying homes at steep discounts, using loans from state banks and turning them into affordable housing. OpenAI's co-founder and chief scientist Ilya Sutskever is leaving the company. Sutskever was a key figure in the brief ouster of CEO Sam Altman last year. He'll be replaced by the company's research director. In a post on X, Sutskever called the trajectory of OpenAI miraculous and said he was confident that it will build technology that is, quote, both safe and beneficial under current leadership. Secretary of State Antony Blinken has received mixed reviews for a one-song gig in a Ukrainian bar. Blinken is visiting the country to reaffirm America's support for Ukraine as it demands more weapons to repel intensified Russian offensive. So here is the U.S. Secretary of State and his guitar.
The United States is with you. So much of the world is with you. And they're fighting, not just for free Ukraine, but for the free world. And the free world is with you too. So maybe we can try something?
Yeah, sure.
I don't know if we can.
I think that's enough of that. The performance of Neil Young's Rocking in the Free World drew criticism from some, with Ukraine's former economy minister calling for more action over words of support. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. I'm really not sure what I think of this. What are your thoughts?
Either the Secretary of State. He said, so maybe we could try something. I don't know if we can pull this off, and then started playing. And I think people are still judging whether or not he pulled it off.
Yeah, I'm not sure that's the right setting to play the guitar, but hey, who am I to say?
You mean in Kiev, as a war rages on, and weapons haven't gotten there, and they're basically saying we're losing because of it? Just saying.
But hey, look at me.
Look, rocking in the free world.
Yeah. Up next on the program, the Biden administration raising the stakes with China.
Not taking action is going to allow the takeover of so many strategic sectors by Beijing that we have seen before. Steel and aluminum, solar, and now batteries and EVs.
That conversation just around the corner, live from New York City this morning. Good morning. Equity futures just about unchanged on the S&P 500, 2 hours away from the big economic data of this morning and arguably of the week. Equity futures going nowhere. Yields are lower by 2 basis points on a 10-year, 4.4179. Under surveillance this morning, the Biden administration raising the stakes with China.
We have indicated to China that this is not an intention to escalate or even to confront. It really is on our side. A set of defensive measures. We know that not taking action is going to allow the takeover of so many strategic sectors by Beijing that we have seen before. Steel and aluminum, solar, and now batteries and EVs.
So here's the latest this morning. China vowing to take resolute measures in response to a fresh round of tariffs from the Biden administration. The tariffs targeting imports of strategic materials, including semiconductors, solar cells, and critical minerals, including a 102% tariff on Chinese EVs. To discuss, joining us now is John Lieber of Eurasia Group. John, wonderful to hear from you. I am less interested in how China's going to respond to this and far more interested in what Europe is going to do. Is Europe going to have to eat all this overcapacity coming out of China, given America's putting up the walls to it?
They will until they have time to put up a tariff regime of their own. I mean, the European strategy seems like it's more about partnering with Chinese companies to encourage domestic development in Europe of these Chinese producers. They've been far more open to Chinese electric vehicles on their roads than the Americans have. And it looks like their long-term strategy is to try to help build that manufacturing base the way the Japanese automakers and the German automakers have inside the United States. But in the meantime, this is a big market opportunity for China to get in there because they're not getting into the American market anytime soon.
We've seen this administration really want to take a multilateral approach when it comes to China. Why did they go do this on their own and not wait potentially for Europe to be there with them?
Well, I think that raises the question if this is actually about Chinese overcapacity and about Chinese industrial development, or if it's about the United States' ongoing both national security concerns and, of course, the election, which is looming large over all these decisions. Joe Biden cannot win this election unless he wins probably all 3 of the blue wall states in Pennsylvania, Michigan, and Wisconsin. And these EV tariffs get right at the heart of that auto production sector. And if there's any doubt this is actually about the election, look at the way that they delayed
the effect of these tariffs until after 2025, suggesting they know there's going to be some inflationary impulse, but what they're worried about is more about this China narrative that's been stoked by Donald Trump than they are about the inflation.
John, when Trump did this, Biden criticized him, saying tariffs are inflationary. Anyone that took Eco 101 knows that. Then we had Ambassador Tai yesterday. She was asked about this, and she said that link in terms of tariffs to prices largely debunked. What does this administration do? Do you have a clear answer from them? Because I certainly do not. If they believe tariffs are inflationary.
Well, I mean, this is a relatively small number, right? So I think that's a big part of this. I think it's also the delay until after the election. But the fact is, it's hard to see how these don't end up increasing prices in some of the sectors that they've been targeting. One of the ones I think is most interesting is solar cells, where the United States has really struggled to develop its own domestic solar manufacturing sector and is very reliant on imports, and particularly imports from China, to deploy the magnitude and levels of solar that the Biden administration wants to get out there. And of course, this runs entirely contrary to that and is going to make it harder to deploy these solar cells in the United States. So they seem to be willing to take that hit on. They seem to think the threat from China is real, and this is either in the long-term interest of the United States or their own short-term political interest.
John, I want to pick up on what basically you said, which is this isn't necessarily going to be so inflationary because I believe one report said it's $18 billion of goods. That's nothing in the scheme of trade relations and the U.S. economy. It's more maybe signal than noise. Do you have a sense of what comes next, of what this is a predecessor to in terms of Joe Biden's policies and additional tariffs that could be levied?
I think the thing to watch next is Mexico, because if this really is about getting Chinese goods out of the U.S. supply chain, China's made big investments in Mexico over the last several years. Mexico obviously has a free trade agreement with the United States, so a lot of those goods can sneak into the American supply chain through Mexico. And both Donald Trump on the campaign trail and Catherine Tai yesterday at the White House called out Mexico as the next place where they're going to be looking to get Chinese goods out of the supply chain. So I think that's a potential threat. Trump tried using tariffs on Mexico to that effect. And I think that's something that the Biden administration is looking at very closely right now.
John, with all of your experience in Washington, D.C., I'm wondering if this is what you think is the correct approach, given the fact that it certainly seems like China is ramping up the tension, ramping up the pressure. Vladimir Putin over in China, visiting with Xi Jinping, reiterating some of the no-limits type of friendship that they've been engaged in. How much do you see them sort of calling the bluff of the United States in some ways and saying a lot of this has been lip service that we've heard for a long time, but it doesn't have the teeth to really prevent what we're planning to do, which is to sell cheap goods to the rest of the world?
Yeah, forced goods decoupling with China is probably an unrealistic goal. I mean, China has taken over the manufacturing supply chain of just so many industries over the last 30 years with the help of U.S. technology and U.S. investment. And it seems very unlikely that the U.S. is going to be able to unwind that, or that the U.S. would want to unwind that, given what it would do to consumers and prices. Now, that said, these are, critical sectors the U.S. wants to be a leader in the future, and it's very difficult for the U.S. to compete with the level of subsidies and the overcapacity that exists in China. So directly confronting them through tariffs is probably not the best way. The U.S. used to do this through engagement with China by bringing them into the WTO. Obviously, that didn't work very well. And this is going to be a major long-term challenge for whoever the next president of the United States is to figure out how to both balance America's domestic development needs with this both national security and economic competition with China.
John, do you think we're at the start of a new trade war with China?
I think we've been in a trade war with China for 30 years. I mean, I think it started when China took an opportunity to, take American dollars and finance our deficits and send us cheap goods. And the U.S. started to respond. The U.S. attitude towards that trade war started to shift in 2016 with Donald Trump's presidency. And now there's clearly a bipartisan consensus that it's going to escalate probably over the next 5 to 10 years.
Hey, John, thank you. This story's going away no time soon. John Lieber there of Eurasia Group, breaking down the latest efforts coming out of the United States. Good politics. This has nothing to do with economics and everything to do with November. You come out with a number like 100. Isn't that just to remove this as an election issue through the rest of this summer?
Well, the interesting thing about 100 was 100 on what? There's not a single Chinese EV right now in the United States. So Precisely. It's symbolic. But what the administration will tell you is that they're looking out and potentially wanting to make sure that the walls are up so that they cannot get here, making it even that much harder.
What are the Europeans going to do with this? They're just going to sit there and take it?
I mean,
just take all the imports, allow the factories to be built on the continent?
It's a great question. We heard Emmanuel Macron welcome in Xi Jinping, and we saw everybody else kissing the ring. So here's a question. How much do they build walls, and how much do you start to get divergent policies, depending on whether you're Germany or whether you're France?
Fascinating. Much more on this story a little bit later. Up next on the programme, we'll catch up with Virginie Maisonneuve of Allianz Global Investors, counting you down to key data 2 hours away. It is CPI Wednesday in America, live from New York City. This is Bloomberg. Live from New York City this morning. Good morning. Within striking distance of all-time highs worldwide and here in the United States. Equity futures just about positive on the S&P. On the Nasdaq 100, just about negative by only 0.02%. Treading water, as you might expect, going into two big prints 2 hours away, CPI and retail sales. If you switch up the board and get to the bond market, I want to talk about where we were the last time we did this. The 2-year that morning on April 10th opened up at 474 and closed at 497.31, higher by more than 20 basis points. Lisa, following a hot CPI print, we've had a few of them. Can we break that streak?
And think about how far we've come back down, given the fact that we are now looking at a 10-year yield that is around the same level as it was before we got the last CPI print. So we've gone full circle in that time. The way the market's prepared right now is for a rally. They're basically looking for some sort of a positive downside surprise. 22V research showing that 49% of investors expect the market reaction to CPI to be positive, which really speaks to this idea everyone's looking for a reason to buy rates.
And only a fraction of that looking for it to be negative. Based on the price action we've seen coming into this, we've rallied into this move, both in the equity market and in the bond market as well. Let's turn to foreign exchange and finish on the euro just briefly. On a euro right now, 108.27. We're positive there by about 0.1%. That is a slightly stronger euro, but as we've seen through this morning, really muted price action. You just wonder how hypersensitive we still are in either direction to any data we get in 2 hours' time.
I guess it depends on what it is. Part of the complication today is the 1-2 punch of both retail sales and CPI. On one hand, yes, CPI in the front and center, but on the other, what happened to stagflation? Last week it was stagflation. Now we're back to Goldilocks. If you blink, you're going to miss the narrative shift. How much do we get some sort of conflicting narrative discussion on the heels of some of these data points?
I like the way our good friend Mohammed Al-Arian put things. Stagflationary wins. You don't argue against that, right? Just sort of stagflationary wins. Does that work?
I guess it works. I mean, we heard it yesterday from Bank of America. They're talking about this potential of people are concerned about stagflation. But Lisa, when you talk about 22V research, 49% are expecting the market reacting to CPI to be risk on. I come back to yesterday's PPI. The previous month, that revision was massive. This is the problem with being overly data dependent, which is what UBS's Paul Donovan has to say this morning.
Well, this is a reason why you've got people like Mohammed Al-Arian talking about coming up with some sort of thesis. The problem is, and Jay Powell laid this out yesterday, which is they're getting less confidence. We are seeing an annualized pace of CPI at 4.5% for the first quarter. That is up from 3.3%. Yes, we're posed for the lowest month-over-month CPI read right now, but it's down from something that has been too high, and people can't ignore that.
Less confidence about what, though? The base case. And the base case hasn't shifted. That's what really strikes me about Chairman Powell. It doesn't matter what the data said so far year to date. Hasn't really changed his ultimate view about what's going to happen in the back half of this year.
There still is this belief, at least on the surface, right now stated, that we're heading back down to a rate environment similar to what we've known in the past, a sort of neutral rate. They haven't shifted that, even though the market seems to have moved on.
Yeah, the market's moving on and moving on quickly with that conversation. The Federal Reserve seemingly not engaging. Under surveillance this morning, if you are just joining us, our top story, investors looking ahead to CPI and retail sales in about 2 hours' time. The median estimate in Bloomberg survey expecting core CPI to tick down to 0.3% month over month from 0.4, plus another read on the US consumer with retail sales data ahead of Walmart earnings tomorrow. Up next, multiple reports saying the Biden administration is looking to send another $1 billion in aid to Israel. It would be the first shipment since a transfer of 3,500 bombs was halted. The White House is also opposing a Republican bill in Congress which would force the president to send assistance to the country. That fight in Washington heating up again.
It is. And this is the balancing act the Biden administration is trying to strike. So, yes, they said no to these bombs, but they didn't say that they were going to stop all aid. And what you're seeing is that they have this procedural move, alert Congress that we are continuing. But what kind of message does this send to the progressive left that they have been trying to come on board and say we are doing our best to try to temper what's going on in Israel?
Messaging versus actual policy has been sort of the difficulty all along, and this only adds to that confusion. I got to say, I'm actually more interested not just in what the U.S. is doing with their weapons shipments, but what Egypt is doing and what Saudi Arabia is doing in response to Israel's move into Rafah. I wonder how much and how closely the U.S. is speaking with some of these allies to try to come up with some sort of cohesive policy.
Yeah, here. I think we all agree with you on that. I want to turn to our next story. Comcast betting on the return of the bundle. The cable company saying it will offer a streaming package which will include Apple TV+, Netflix and Peacock at a vastly reduced price, according to CEO Brian Roberts. The new bundle, called Stream Saver, will be officially introduced later this month. What do you think of the name?
Okay, Stream Saver, what do? Go to I feel like it's a grocery store. It's Price Chop, come on down. To me, this is screams of Peacock. Listening to what you had to say, John Ferro, as you were talking about how you can't ever find what you're looking for, and they're the worst at this, etc. They've got the lowest retention rate among the major streaming services.
Didn't know that. That's interesting.
Starz only has the worst, but in terms of their churn, which gives you a sense because you've got to sign up for free and you get these things and you just cancel it, and that's what everybody does. They've got the lowest duration of subscribers. This is what they're trying to combat by lumping it together with some of the others.
But you have to think, Apple TV+, Netflix, that's not a bad deal, all of these together. But how do they decide who gets paid what out of this bundle?
That I don't know, but Lisa's right. This is about avoiding churn. Because for me, for Peacock, let me be honest, once the Premier League season's finished, I don't need that app anymore.
You're not alone.
Now, whether I'm going to be super lazy and stick with it, possibly, but for a lot of people that are a bit more active and focused on this kind of thing, I'd cancel that thing on the final game of the season in the final minute.
Can I just say, I admire those people. I want to be one of those people who's on top
Super
of it
on top
enough,
of it.
who just can cancel and then reintroduce it. But that's exactly the reason why. They don't have that stickiness. It's something like less than a year is the average duration of their subscriber versus some 4 years for Netflix. I was looking this up this morning because I was thinking, why are they doing this? And it was just to cater to people like you.
This is where the world has been going for quite a while. This is the direction of travel. I'm not the only one complaining about this and haven't been the only one complaining about this.
It's legitimate.
For a long time. Our top story then, Fed Chair Jay Powell looking to wait and see.
The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work.
So here's the latest this morning. Fed Chair Jay Powell reiterating the Fed will likely keep rates higher for longer, citing lack of inflation progress. We'll get fresh data on deck with CPI at 8:30 Eastern, following yesterday's PPI report, which Powell called mixed. Virginie Maisonneuve of Allianz Global Investors expecting headline inflation to stay in the range of 0.4% month over month, in line with the latest CPI report. Core inflation likely to moderate to 0.3 month over month. Virginie joins us now for more. Virginie, if we get those kind of numbers at 8:30 Eastern, what kind of reaction would you expect in equities?
Well, I think it's a symbol of this transition period that we're in, right? We're looking at growth deceleration and inflation stickiness, but we know there's always a lag. So I think the market has positioned itself for quite a positive perspective. And if we have something that's in line with last month with a little bit of an improvement, I think we could have a little bit of a comeback in the market. But after that, if you want the confirmation that we are in fact in this transition period, the higher for longer is going to stay there. But I think, if you look at some of the indicators, 80% of the inflation overshoot has been from auto insurance, for example, and rents. When you look at rents for new tenants in the US, it's growing at about 1%, but rent CPI is growing at about 6%. So again, this idea of a lag, right? Existing house prices up 6%, but new home prices down about 20%. So I think you're in that transition period, and we just need to go through it.
Virginie, CPI is the main event. That's what a lot of people are focused on today. And yet, as Annmarie alluded to earlier, some people are more focused on retail sales. How much more important to you as an equity-focused investor are retail sales to gauge the exceptionalism of the United States versus an inflation story that's difficult to really get a handle on with any precision?
Yeah, exactly. So, from an equity perspective, if you look at it from a bottom-up angle, inflation is still important because it carries some level of pricing power or some level of cost increases, right, depending on where it hits. So it is something that you want to have in mind, particularly with the impact it has on rates, because obviously rates, particularly if you go look at the growth style, long duration stocks, will be impacted by that. The retail side clearly is a bit different. It's more stock related. And if you look at how the US economy is dominated by consumption, understanding this lag and this relative deceleration, as we talked about just a minute ago, between growth and inflation is very important in terms of pricing power for the consumer, but also to understand if companies have basically ridden the revenue growth, but we see margins and profit growth are not following, and therefore could be at a turning point.
So we've been talking about how certainly the bond market's positioned for a rally. Are you looking for a buying spot with respect to equities on the heels of something that really just comes in line, both with respect to CPI and retail sales?
Yeah, so from a bottom-up perspective, whatever dislocation we might have or not, it's all about price relative to our expectations of growth and valuation potential. There's always opportunities. What is a bit interesting is that clearly the US has done very, very well, but I am noticing really some factors for Europe at this point. For the first time, we've had growth in Europe after 5 quarters of stagnation, especially in Portugal and Spain, more modest in France and Germany. We are seeing rate cuts coming. Valuation is very cheap. I think it's about 20% cheaper on a sector-adjusted basis than the US. When you have global PMIs moving differently than US PMI generally, that favors Europe. And of course, the demand aspect to the lending condition is quite important because we have to remember that 70% of financing in Europe is done via bank lending versus 30% in the US. So I think there's a position in general to be underweight Europe, and I think it might be an opportunity to add to that area.
When you're looking at Europe and you're looking at the international space, how concerned are you about what you saw yesterday out of the United States and potentially more of a tit for tat between Washington and Beijing, and how investors might get, in the middle of those crossfires?
Yeah, that's really interesting. So let's put things in perspective, right? Two major items. One, we're only talking about 18 billion worth of goods versus, a much larger amount, 427, I think, imported from China in 23 from the US. So it's very small. Really, the only impact, so I think there's definitely a political move here. The only impact is on the lithium battery, which is 20% of total export for China, and of course 72% as a percentage, a much higher percentage for the US. But at the same time, if you look at the export of China to the US in battery, about 400 million versus 7.5 billion equivalent for Europe. So it's still very small. So you have that political move. And of course, Biden has never taken out the tariffs that Trump has put in. But I think what's really interesting is how do we think of the world decarbonizing in the face of very steep, climate issues without China? We have to remember that China has built a lot of this capacity because as the largest emitter, it wanted to contribute, right, of course, at a profit, but to that solution. And if you look at EV, if you look at solar, etc., so, what do we do without a China? Are we going to delay dealing with climate for trade reasons? It's going to be a really interesting, discussion. And of course, the key here for China is what does Europe do?
Well, so if you want exposure, though, to that trade, then does that mean buy Europe? Because that's where all these Chinese goods are ending up.
Yes, and Europe is a leader in electrification and decarbonization, et cetera, absolutely. But the key thing is Will Europe follow the US in terms of tariffs? That would have a big impact. I think depending on the election in the US, it is, particularly for Germany, important to keep that link with China from an economic standpoint.
Let's just be clear here, Virginie. What happens to domestic sales of Mercedes-Benz, to BMW, if they don't put up the walls in the way the Americans have just done in the last 24 hours?
Yeah, you've put your finger on it. Clearly, very large employer in Europe in the auto industry. Definitely a topic of discussion. So you have that employment, if you want, aspect versus the long-term aspiration of decarbonization. And so I believe that ultimately what we'll have is some level of collaboration that needs to take place, to combine both, right? And an evolution as well of the auto companies in Europe.
You've got to pick your priority in Europe right now. We'll find out which one it is. Virginie, thank you. Virginie Maisonneuve there of Allianz. Is it about addressing climate change, big focus for the Europeans, or is it about keeping people employed at German companies?
This has been one of the criticisms levied at President Biden, basically, that he's got to pick one. Taking a step back, this has been the criticism levied at Germany and Chancellor Merkel for a long time with respect to Russian oil. There has been so much discussion, and frankly, I wonder how much the public rhetoric versus the private rhetoric of BMW and some of the others really does conflict. But when you take a look at the overproduction in China, they could potentially supply 20% of the cars in this world if they start to export what they have available. This is not something that could be tenable for some of these auto manufacturers.
It's massive, but the BMW chairman recently came out and he said, well, actually, we might end up hurting ourselves. We shouldn't be so afraid here in Europe. But Elon Musk, remember in January, what did he say? He said if there are not trade barriers established, China will demolish the entire market. Very different views.
Elisa touched on it. We've said it before on this programme. What the German automakers say publicly and what they might say privately could be very, very different on this issue. Are you telling me they're ready to compete with the Chinese likes of BYD in mainland Europe in a big way? Are you telling me they wouldn't like to see the same kind of tariffs we've just seen from President Biden in Europe?
And are you saying that they could say publicly any of that, given the fact that one of their biggest markets is selling to China at a time when it's unclear how long they'll be able to do this? A lot of lack of clarity here, but the bottom line is this is a big challenge for any auto manufacturing outside of China.
Without a doubt. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. Boeing may face criminal prosecution after the U.S. Justice Department said it violated an agreement tied to 2 deadly crashes 5 years ago. The $2.5 billion settlement in 2021 had allowed Boeing to avoid criminal charges, but according to a filing, Boeing has breached it by, quote, failing to design, implement, and enforce a compliance in preventing and detecting violations. Now Boeing has 4 weeks to respond before next steps are decided. London may finally get its first sizable IPO since February. PC maker Raspberry Pi says it's considering an IPO in the city. The company didn't disclose how much it plans to raise, but it's seeking a valuation of about $630 million. Raspberry Pi had first considered a listing in 2022, but according to reports, it has since raised funds from the likes of ARM and Sony's semiconductor unit. And Caitlin Clark's WNBA debut got off to a tough start. She finished her first game with 20 points, but that wasn't enough for the Indiana Fever to beat the Connecticut Sun in their opener of the season, rather. Clark shook off some early nerves, missing her first 4 shots and going scoreless for almost the first 15 minutes of the game. Her home debut is tomorrow when the Fever host the New York Liberty. And that's your brief, John.
Very cool. Danny, thanks for the update. We'll catch up with Danny again in about 30 minutes' time. Coming up on this programme, we'll take you live to the Qatar Economic Forum in Doha for a discussion between Bloomberg Editor-in-Chief John Micklethwait alongside Nir Bardea of Bridgewater and Dina Powell McCormick of BDT and MSD Partners. That conversation is just around the corner. Good morning to you and welcome to the programme. Equity futures on the S&P 500. Treading water here, going into that big print a little bit later this morning, 8:30 Eastern, CPI and retail sales. Let's take a second now and take you over to the Qatar Economic Forum over in Doha, where Bloomberg Editor-in-Chief John Micklethwait is joined by Nir Bardea of Bridgewater and Dina Powell McCormick of BDT and MSD Partners.
We think this reality is here to stay. We started this year with 6 easy kind of priced in. Everybody thought No, we're going back. We're going back to that world. And now we've seen the market correct. And we think that's going to be the dance. That's going to be the dance that the Fed and all of us are going to have to dance in the U.S. And by the way, when you look at that, also look at the divergences. We tend to talk a lot about the U.S., but the picture you see in Europe and other places is vastly different. It doesn't make sense to us, to Bridgewater. It didn't make sense. There will be 6 easings. Still probably wouldn't make sense to us. There will be any easings this year. But you look at Europe, you look at what Switzerland just did, different picture, and you see divergences in the world that are also interesting for investors who are looking for opportunities about how to deploy their capital.
Just quickly on that, do you, when you look at Europe, I mean, again, having just come from seeing Macron on Monday, his whole pitch is that Europe is sclerotic. It is not, it needs to reform itself dramatically. And I looked at the numbers, even France, which has done quite well since he became president, has grown half as fast as America. Is there any, do you see any sign in your world that is changing from the past decade to the next? Do you see any sign of a kind of rebirth in Europe?
So I would separate that secular and cyclical.
Yeah.
So secular, I do think there's a lot of things that fundamentally need to be reformed in Europe. That's been talked about in Asia. But cyclically, I do think they are in a better spot. I mean, if the U.S., I believe, in order to slow inflation, will need actual restrictive policy. Like the reality is that to bring inflation down, you have to slow the economy.
Yes.
It's just the way it works. In Europe, they're past that point. They're much more ready at this point to ease.
Slowing the economy, I think we can agree Europeans are brilliant at it.
Yeah, they're very good. It's a talent.
It's something they can do without.
But at this point, they can actually stimulate. They are past that hump, and so in that sense, cyclically, there's room for optimism in Europe.
Dina, what about you? Just two things just on Europe, but then maybe we could come on to the Middle East as well.
Well, I just want to follow up on one thing Nir said. I completely agree with his view of monetary and fiscal policy, and the levers have almost all been used, and kind of we are where we are for the foreseeable future. I think it's interesting that if you look at any of the polls, you guys just recently did a bunch of polls, it's the #1 issue on voters' minds. And so I think that while it's talked about a lot, again, from what the perspective of the Federal Reserve, I actually think it's going to be the deciding issue in the U.S. election. And I think that people feel it in a way that is stronger than it has been felt in the cost of goods, and yet the decreasing in wages. And so I think that that's going to be the big issue to watch in terms of economic policy. People think it's going to be national security or social issues. I think inflation is #1.
You would agree, presumably.
I mean, especially, I think economy is always a big, but I agree with everything Dina said, but especially because it leads to also the type of stuff that changes politics. So we talk about social inequality. Wealth is also incredible. I mean, one of the things that is leading to inflation is, gold, Bitcoin. There's a lot of stuff that creates wealth that is certainly blooming in this environment of ample liquidity. So it's a subset of the population feels the inflation when they're going to the gas station, and a part of it feels incredibly wealthy. And so it's both what Dina's saying and the fact that it's kind of tearing society apart from a social inequality standpoint.
It is, and you were talking about what's happened in the last 10, 15 years and why that wealth gap has grown so much. I mean, people who had assets. Well, you didn't have to be that smart. I mean, Bridgewater is, of course, uniquely smart. But if you had assets, your wealth and income rose, and if you didn't, you got really squeezed. And I think that's where you see the tension in that income inequality.
Can I come on to one last bit very quickly, which is this region? It's obviously, as you can see, this is a massive source of capital for financial firms to redeploy. But in terms of a target for investment, how do you see that? Maybe Dina, go first, and then.
I'm bullish. I'm bullish because I've, over the last several years, worked on these issues, been in the region. I see the genuineness of the desire to move forward on the social, economic, and political reforms, although imperfectly, and certainly with some steps taken back. And frankly, it's in the U.S. national security interest that those reforms are completed, and for our allies as well. And so I think it's like a genie out of a bottle. I think once you get moving in that direction, it's hard to go back. And I actually think that it is very likely that And we know this, that the Saudis and Israelis were very close to normalization. And in some ways, there's a saying, don't waste a good crisis. And this horrific tragedy and crisis could actually be the final straw in between those two, axis of resilience and axis of resistance. And
you can watch the rest of this panel and all of our coverage on the Qatar Economic Forum on the Bloomberg terminal at Live Go. That conversation, Bramo, actually pretty interesting. Monetary policy unchanged for the rest of the year seemed to be the consensus view on that stage.
Given the fact that inflation is so strong, and Dina saying that this is actually going to be the number one issue that's going to really affect the election.
We'll continue this conversation in the second hour of Bloomberg Surveillance. Coming up next, Evan Brown of UBS, the former House Speaker Kevin McCarthy, David Livingstone of Citi, and Ian Lyngen of BMO. From New York, inflation data and retail sales just around the corner.
Market can do very well with the Fed on hold. So the good nominal growth environment has been supportive.
I don't see the stagnant. I don't see the inflation. We're still growing. We're still growing at 1.5%, 2%.
We're just still running too hot for the Fed to comfortably cut rates significantly with the economic data as strong as it is.
That the Fed will cut later this year. The path to normalize rates and normalize inflation is going to be longer than the market perceives.
We're still in the pivot party, I would say, and Chair Powell's been the lead bartender on this.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
And he was serving drinks yesterday. Live from New York City this morning. Good morning, good morning. 90 minutes away from inflation data in America. 8:30 Eastern time looks a little something like this. You get US CPI, then retail sales, then three Fed speakers follow up. Look out for Kashkari and Bowman. Quite hawkish at the hawkish end of the spectrum over on the FOMC. The estimates this morning, Lisa, headline, month over month 0.4. Core, stripping out food and energy, 0.3.
Which would be the lowest reading of the year, which is the reason why people are prepared to really lean into this pivot party. You said that he was serving drinks yesterday. Was he? He's trying not to, but everything that he does, it's sort of, here, you get seltzer today. And they say, no, we don't. This is actually spiked. It's hard seltzer. And that seems to be kind of the disconnect that we hear.
The bias hasn't shifted. The bias is to cut interest rates. And I think the base case for them hasn't changed. The probability around that base case might have shifted. They talk about their loss of confidence over the last few months, but ultimately they still believe they're going to cut later this year.
This is what Powell was talking about yesterday. He says all of those things lead us to believe at this time that policy is restrictive and it looks like it'll just take longer. We will get there, but it'll take longer. But if we're looking on a month-over-month 0.4% higher, that brings CPI year over year at 3.4%. How many good data points do they need to get closer to even 3%? Not even on the 2 handle that he's looking for.
But you raise this great point. Is it enough just to say we're not going to hike anymore? Is that really enough? Is that to keep this going, given the fact that, OK, we've gotten that, they're not going to hike. OK, it's higher for longer. If they really don't cut rates at all this year, does that really have no effect on equities whatsoever? That seems to be one of the themes that we hear from everyone.
I asked a version of that question in the last hour with George, and I think it's the right one. Are we reaching limits of that? How much comfort can you take from data moving in the wrong direction just because you believe the Fed's not going to hike? What about that phrase we've been talking about to credit investors, survive until 2025? Do you get to a point where interest rates are pushed so far off into the horizon that it actually becomes a problem? And bad news really is bad news.
And this is the reason why you do have some people who still are kind of beating the bearish drum and saying it's all going to fall apart and, and it might fall apart later than we had previously expected. And then other people say, actually, no. This is it. This is the new normal. We can chug along at these rates and just move forward. This is the divide between people who both want to rally in the bond market and a rally in the equity market at the same time.
That data is just around a corner, and equities and bonds have been rallying at the same time recently. Equity futures at the moment, the scores look like this, just about positive on the S&P 500. In the bond market, yield to lower by 2 basis points, 441.98 on a US 10-year. Coming up this hour, we'll catch up with Evan Brown of UBS with stocks near all-time highs. We'll speak to the former House Speaker Kevin McCarthy on the 24 election race and BMO's Ian Lyngen on what the CPI print could mean for markets. We begin with our top story. Equities nearing all-time highs ahead of US CPI data. Evan Brown of UBS writing this. Our risk-on positioning has been informed by a simple premise. If central banks are cutting rates into an environment of already healthy backdrop for nominal growth, that would be a uniquely positive backdrop for stocks. Evan joins us around the table. Evan, good morning.
Good morning, John.
Do we have a uniquely positive backdrop for stocks?
Yeah, I still think so. I mean, maybe we've pushed out the timing of rate cuts a bit, but the fact is we're in a healthy nominal GDP environment, right? We're talking about 5 to 6% nominal GDP this year. In the prior cycle, we were under 4% on average. And that's a good environment for earnings, and we just saw that this earnings season, best one since 2021.
How big is that window? Lisa talked about the new normal, maybe even the old normal, going back to where we used to be 20 years or so ago. What is the new equilibrium, if we can call it that?
What's the new equilibrium? So I think where we are now is essentially the new equilibrium. I don't think we're getting back to 2% or below 2% inflation on a sustainable basis. I think we'll be somewhat above. 2% was more the ceiling of the last cycle, and it's going to be probably more of the floor this cycle. But that's not such a bad thing. I mean, I know that the Fed is talking about we have to get back to 2%, but I think there's a little wiggle room there. I think when it comes down to it, if they say that those last few tenths of a percent are worth destroying the labor market, they will hold off on that, and they're going to be very sensitive if we start to see the labor market crack. They'll be sensitive even if we're not quite at that 2% level.
A lot of people have been very surprised about the strength in the economy, about the strength in equities, the strength in profits. And a lot of this has really stemmed from the great fiscal transfer, that we have incredible amounts of government money funneled not just to consumers, but also to businesses that hasn't even been distributed yet. How much do you bank on the fiscal impulse overwhelming any monetary impulse for the foreseeable future? Is that essentially the bet on equities right now?
I don't think it's all fiscal. I mean, certainly it has helped the economy, and it certainly helped the economy coming out of COVID to get those big fiscal numbers. But I think people overstate the fiscal and understate the this is an income-driven cycle. Real incomes have been improving significantly as inflation has come down. Nominal incomes have been remarkably steady, again, growing over 5%. And so if that's the case, right, if people wages are in decent shape, if employment growth is in decent shape, hours worked in decent shape, then they'll be okay, even as some of those excess savings are dwindling.
If the way that you portray it is the way that it plays out, which is sort of not early cycle, but more mid-cycle than certainly late cycle, why not get all into small caps? Why not say, you know what, it's going to start broadening out, and we've already seen the beginnings of something that is sustainable and based on fundamentals?
You need to start seeing rate cuts to get small caps going, because the small caps really depend on much more on financing than some of these like cash-rich large cap companies, and so their margins. The longer that we have if we have rates higher for longer, that is going a steady bleed in their margins, and so if that's the case, then to really get that small cap rebound, similar to what we saw in Q4. You really need the start of a rate cutting cycle, and it's not here just yet.
It's the rotation everyone's been itching to make for the last 4 or 5 months. In fact, I'd go back even longer than that, but we'll save that. I want to congratulate you for a call that you made in the last year or so. There has been a big spread between manufacturing and services, and a question we've asked around this table for a while is how we'd close that spread from either direction. How would we converge? And you said manufacturing would come up to services. That started to happen over the last few months. Can you talk to us about another spread that we see, and it's between the US, the perceived spread between the US and the rest of the world? How do you think that's going to converge in the years to come?
Yeah, so I think it will converge. I'm not looking for the US to fall off a cliff or anything. It's more about the rest of the world picking up, and it's related to that manufacturing versus services call that just most of the rest of the world is more export driven, more manufacturing driven than the US. But I mean, we want to be early to trends, and if you look at your Bloomberg machine and you look at all the growth revisions this year, and they've just skyrocketed for the U.S., and then you see Europe and China kind of hanging out, Japan on the low end, but you're starting to see a little life there in those growth revisions. Economists in Europe are starting to revise up growth because inflation has come down in Europe, and that is finally getting the European consumer a little bit more confident about spending. And so, I think the combination of this improvement in manufacturing, which is linked to inflation really coming down faster in some of these countries than in the U.S., and so that helps the domestic consumer. That also helps manufacturing and exports.
That has implications, of course, for markets, equities, rate differentials, and implications for FX. Where does that leave the dollar?
Yeah, so dollar, I think we've got room here for a little bit of weakness in the near term as you get this global rebalancing. But I wouldn't extrapolate that too far for two reasons. One is that structurally there's still this very big disconnect in terms of how sensitive the consumers and businesses are to higher rates in the U.S. versus the rest of the world. We've got our 30-year fixed mortgage, and most other countries are dealing with the variable rate. Rate cuts outside of the U.S. are going to help a little bit with that, but that's still a constraint. But that's the first reason. The second reason is, look, we got a 50% chance of a Trump presidency, maybe more. And people aren't talking about it as much now, but a few months from now, we are going to be talking about 10% tariffs on all U.S. imports. We're going to be talking about 60% tariffs on all Chinese imports from China. And there's going to have to be some risk premium put in basically every other country outside of the U.S. to reflect that tariff risk.
Why is it a risk premium on the other countries and not on the United States of becoming increasingly isolated?
Well, I think it's part of this kind of like natural global rebalancing when you have tariffs, or we would need in the U.S. if Trump is going to put on the kind of tariffs that he's talking about, we need a stronger dollar to make sure that inflation doesn't get out of control. The dollar needs to offset that to bring inflation down here. So I would expect the tariffs to be a headwind for the U.S. as well. But there's two sides of the same coin here, where it's weakening the rest of the world, but also we need that stronger dollar to contain inflation here.
We'll speak to a man with opinion on that in just a moment. We'll catch up with Speaker McCarthy in about 5 minutes' time. Evan, great to see you in person. It's good to see you, buddy. Thank you. Evan Brown there of UBS. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Primary elections were held yesterday in Maryland, West Virginia, and Nebraska. One race in particular could determine control of the Senate in November. That is Maryland, where Angela also Brooks defeated one of the richest members of Congress, David Trone, in the state's Democratic Senate primary. She will be facing the Republican government, Larry Hogan, in November. It's expected to be a competitive race that could tip the balance of power in the Senate. Copper is rallying to a new record high in New York, up some 24% over the past year, driven by a short squeeze. Futures surpassed the previous record that were reached in March 2022. Traders have snapped up call options on the COMEX, with the premium widening on demand for upside protection against a further rally. A group of TikTok creators have filed a suit to block the law forcing parent company ByteDance to divest or face a ban. A lawyer for the creators said, quote, they hope to vindicate not only their First Amendment rights, but the rights of the other approximately 170 million Americans who also use TikTok. A spokesperson for the Justice Department said the government looks forward to defending the law in court. That's your Bloomberg Brief. John.
Danny, thank you. Much more from Danny in about 30 minutes' time. Up next on the program, the U.S. ramping up tensions with China.
For years, the Chinese government has poured state money into Chinese companies across a whole range of industries. When you make tactics like these, you're not competing. It's not competition, it's cheating.
We'll catch up with Kevin McCarthy on the other side of this break. Live from New York. Good morning. Live from New York, welcome to the program. 1 hour, 15 minutes away from that all-important economic data. That's just around the corner. Equity futures going into that on the S&P 500. Just about unchanged. Treading water here, positive by almost 0.1%. Your 10-year this morning, 441.20. Yields are lower by 2 or 3 basis points. Under surveillance this morning, the U.S. ramping up tensions with China.
For years, the Chinese government has poured state money into Chinese companies across a whole range of industries. steel and aluminum, semiconductors, electric vehicles, solar panels. The industries of the future. China heavily subsidized all these products, pushing Chinese companies to produce far more than the rest of the world can absorb. When you make tactics like these, you're not competing. It's not competition, it's cheating.
So here's the latest. President Biden unveiling a sweeping new round of tariffs on Chinese imports ahead of the November election. The decision looks to escalate measures first put in place by former President Donald Trump. The former House Speaker Kevin McCarthy joins us now. Speaker McCarthy, good to see you.
Good to see you.
Great to catch up, sir. What did you think of that from President Biden? Did Biden just out-Trump Trump?
No, he can't do that. I mean, Biden opposed these tariffs before. And I actually believe when it was only Nixon can go to China, I think a Republican administration always has a better relationship with China and a stronger one. We've watched in this current administration, they've created like an axis of evil with Russia, Iran, and China, something we haven't seen since the 1930s. And there's an interesting piece by Henry Kissinger before he passed and Graham Allison, 79, 79, and 9. 79 years since a Great War. 79 years since a nuclear weapon was used, and only 9 countries with the potential of a nuclear, which in the 70s you thought there would be 25 or 30. That doesn't just happen. So foreign policy really matters. The world is in a different place. They're looking for a strong kind of American Western leadership, and I think that's the challenges that we have. And Biden's decision in Afghanistan and what he's just doing with Israel, it's really harming the world, let alone America. And I think greater stability will go a long way.
When it comes to China, though, Biden and Trump are largely on the same path. Trump is talking about 60% tariffs on imports coming from China on top of potentially a 10% tariff wall for all imports. Isn't that trajectory, isn't that the only place, you know this well, that there's bipartisanship in Washington when it comes to China?
Well, you want to look at it. Trump's policies on China, he believed long before he was ever elected. Biden has flipped his position on China in the last year. So it's kind of what you believe. And I think in China's position, China always looks long term. So if they have somebody in there with a strong position, you usually can negotiate something there. I believe, and I think looking at the New York Times latest polling, Trump, election is today, Trump would win, and probably pretty big. Republicans would have a very big night, that you would have an agreement with China. You might think there's a little tension, you'll get a lot of good news for a while, but I think we would be in a much stronger place because there'd be greater respect on each side, and that's where you could come to an agreement.
But an agreement on what?
I think you could get a lot of places on agreement on trade, agreement on the movement of China and Russia and Iran. I think China moving into the Middle East, bringing Iran and Saudi Arabia together, you wouldn't see that as much anymore. I think America would take back the place that they've stood before.
So you were with the former president last night, according to photos I saw online. What are you hearing from him and his team about what 2.0 would look like? Would that also maybe include someone like yourself?
Look, you never prejudge where it is, but I think the president, he's very upbeat. You look at what he's going through. Interesting thing, I think the White House has taken a position, and almost every position they're taking is all political, like this China position, Israel position, what he's looking at. And I mean, if you look at Biden in the last elections, and you're a station that plays with numbers, Biden won the last election by 48,918 votes. But his favorability rating at that time was plus 10. Now it's minus 20. You've got 6 states that are swing states, and Trump has been leading in 5 of them for like 14 months. And now Minnesota, which a Republican has not won since 1972, when Ronald Reagan swept 49 states, he didn't win Minnesota, but now it's a tie within Minnesota. So it's a much different play going forward. And I think their position, they thought going after Trump in a judicial way would help them. I think it's hurt them. You also see independents now. I mean, by a margin of 53 to 42, independents believe another 4 years of Biden will harm democracy. And they say democracy is on the ballot. So it's interesting what they have planned out. And my advice to the Biden administration, if you're in denial, you're not going to solve your problems. And they're kind of in denial of the problems they have.
Can I just ask you a follow-up, though? You didn't answer my question. Would you consider going into a Trump administration?
Look, I would consider to serve anywhere if I'm the best person to. I think in America, we need the best and brightest. But I think that's the last thing you look at. You want to lay out, make sure it's good policies. You want an election to be about policies and ideas. Then people can govern in a better way.
I want to try to strip away some of the politics from the policy and try to understand looking forward. You talk about under a Trump administration, this idea of some agreement with China. I'm more focused on Europe, frankly, because under a Trump administration, it was America go it alone, America first, going out of NATO, really pressuring the European Union to do more. How much is that going to be basically the state of play going forward in the Republican administration at a time where a lot of people are saying you need an alliance to really counter some of these threats that you're talking about?
That's a great question. And we should look, because now we have time to compare what transpired in the Trump administration and what happened now. Was Trump tough with NATO? Yeah, but now you're watching the European nations actually spend more what they had promised to do on their defense, which they haven't. But let me answer your question, okay? Now what you didn't have war in Europe. For the first time in any American administration in modern history, Putin had not invaded another country. Now we have war in Europe. But let me finish your answer to your question. You have 5 American embassies that have now had to be evacuated. We now have a base in Africa where the Russians are now coming into, where you have 1,000 U.S. troops leaving out. It's the place we use our drones and others. So I know what the topic is, and maybe the brushness of Trump's message, but we actually had positive returns within there. So it's a difference of opinion, whether you like the headlines or not, but you really have actual facts on the basis of what a Biden administration looks like in Europe and what a Trump administration looks like.
Although there are long and variable lags with a lot of policies, so it's hard to identify exactly where some of the gains come from, depending on who comes out.
Well, you had the Abraham Accords, which I believe people should have got a Nobel Peace Prize over, but had Biden embraced the Abraham Accords, I don't think you would have had October 7th.
But my question was with Europe, and particularly on the commercial side of things, because what we hear from a lot of executives is they don't know how to even shape policy, given they don't understand what the policy in the U.S. is going to be to European goods. Are they going to start to put up walls to those too to try to really enhance the industrial production of the United States? Are they going to work together? Is there going to be cohesiveness at a time where France seems to open to the idea of accepting electric vehicles from China? How does a Trump administration deal with issues, given the fact that a lot of people say we need these alliances in order to actually win on some of these issues?
Well, I think we have strong alliances. I remember in the Trump administration, I was there with Macron in the White House. I mean, look, every country is going to want to compete with one another. I think what America wants to see is a level playing field. It's a disadvantage if America starts further behind. And France, they want to have a level playing field, but every country is going to compete in different ways. And I just believe at the end of the day, you will find the policies we had under the Trump administration, the policies we have today, America didn't have inflation. We were stronger around the world. Incomes were rising. And what you're finding in the New York Times polls, America sees that too. And I think the number one issue people are going to drive is going to be inflation, the border. Are they going to be the 2 largest drivers of this election?
You don't think that birth control and abortion are going to be a big factor as well?
I do think it'll be, but it'll be in certain spots. It was a big factor in the last election. But remember this. I mean, you also look to what's going to happen in the Senate and what's going to happen in the House. I was leader for 5 years, and every single cycle, when I was leader, Republicans picked up seats, even though Republicans lost everywhere else. When Biden was on the ticket, it was the first time since 1994, not one Republican in the House lost. In the last election, abortion was a very big issue. But as leader, I picked up 5 seats in New York and 5 seats in California. You would say abortion would be the top issues there. So I believe in pockets. Arizona could be an issue. Florida could be an issue. But I think it'll be more in a pocket than it will be national.
You talk about your leadership. Speaker Johnson had 11 Republicans vote to oust him. You only had 8. Democrats came to save him. Are the Democrats in charge of the House at this point?
Hakeem thinks so. I mean, he says it on 60 Minutes.
They saved Speaker Johnson.
Look.
He actually had more Republicans vote against him than you did, but you lost your job.
That's not right, huh? Look, I don't believe in the motion to vacate. I think Democrats play politics on both sides. If they didn't think the motion vacate was right then, why did they think it under me? But it is what it is. It's politics. They think they're going to play it for a political purpose to win. Republicans have a better chance on winning seats this election in the House than they did in the last 2 elections we won. So I think it's going to be a big night. You watch what happened in the primaries last night in Maryland. Hogan is going to make Maryland competitive. And what that does, it expands the playing field. The Republicans are going to win the Senate. It's a simple math question. The presidential election, it's still up in the air, but you look at every polling today, Trump is in the lead, and Biden's doing nothing to change that. In the House, there's a better opportunity for Republicans. The only challenge and advantage the Democrats have is they're beating us now on money rather largely, and that will make a difference.
I've got about 10 seconds left. Can you give us a name for VP? What do you think? Who would you like to see in that seat?
Look, there's some great people, and
10 seconds.
I sat with like 10. Look, I think Tim Scott is great. I think our governor in North Dakota is excellent.
Nikki Haley?
Look, if he picked Nikki Haley, I would say the race is over.
Yeah, I think
the race is over.
That's the entire party.
If you look at the primaries, even in Indiana,
10.
20%.
I've only got 10 left to the break now, Kevin. We've got to go. Speaker McCarthy, thank you, sir.
Thank you.
Let's do it again soon.
All right.
From New York City, this is Bloomberg. "60 minutes away from a ton of economic data here in America. 8:30 Eastern Time, US CPI and retail sales. The scores going into it, equity futures just about positive. Just about. We're positive by 0.04%. The Nasdaq going absolutely nowhere. This market's been going somewhere, and that's back towards all-time highs. Just a whisker away. We'll be talking about them, no doubt, as we get closer and closer to the opening bell at 9:30 Eastern. If we switch up the board and get to the bond market, we've been talking about these levels for a while now. The last time we got CPI data, mid-April, 497 was the closing yield on a US 2-year. We were higher on the session that day by more than 20 basis points. We breached 5%. We came all the way back down to the 470s. Lisa, we're down this morning by 2 to 478.92.
With the 10-year at 440, about where it was before we got that CPI print on April 10th. Again, how much are we set up for a rally, and how much have we baked in the good news of potentially the softest CPI print of the year at a time when everyone's been waiting for disinflation, this Godot-like moment, and it just hasn't come to the degree people have looked for?
Let's turn to foreign exchange just briefly. I'll get you the scores in the FX market. The euro looks like this against the dollar. €1 at the moment, about 108.26. We're positive by 0.06%. That is a slightly stronger euro in today's foreign exchange market. Under surveillance this morning, a key data drop a little under an hour away. CPI and retail sales due at 8:30 Eastern Time. Bloomberg Economics expected the CPI print to show that disinflation has resumed, forecasting core CPI to come in at the lowest mark this year. Elsewhere, a short squeeze driving copper futures to a record high in New York. The premium on copper traded on the New York exchange compared with other global commodity exchanges is prompting a rush by traders to divert the metal to US shores. And finally, more trouble for Boeing, the company facing possible criminal prosecution after the Justice Department found it violated an agreement tied to 2 deadly crashes 5 years ago. The DOJ found Boeing breached a $2.5 billion settlement by, quote, failing to design, implement and enforce a compliance in preventing and detecting violations. Lisa, that stock is down another 1% this morning.
Come on. We've asked for this before. Can we stop getting news from them that indicates that things are just getting worse? The answer is no. And here's the issue. At what point can they put a stopper on this at a time where people are saying, well, are we going to have a shortage of planes given all of the orders that really aren't coming through?
Also, how important Boeing is to the industrial base in the United States. They have 4 weeks to respond now. But what can the Justice Department actually do? How do you punish a company that is so critical to the United States? And not just people getting on planes, but the defense sector.
It's a total mess, let's put it that way. Boeing's a little bit lower again in the pre-market. Let's turn to the IPO market, where listings are poised to slow following 5 straight weeks of more than $1 billion being raised. David Livingstone is the Citi Chief Client Officer, and David joins us now for more. David, good morning to you.
Morning, John. How are you?
It's good to see you. I'm fantastic. Let's talk about where the action is at the moment. We've been saying around this table for a while that maybe the investment banking recession is over, behind us. We want to talk about where things are picking up. The IPO market, how strong is the pipeline for this year?
It's building, it's solid, but the conditions that you want to talk about and that investors are looking at as well as issuers are looking at in terms of rate outlook, and not so much the absolute, but particularly the volatility in the rate outlook. We're sitting here with some of the biggest spread in terms of potential outlook for year-end rates in dollars that we've seen in a while. The issuers are going to sort of are looking at that and saying, well, how does that impact not just equity markets, but also investor appetite to be investing in IPOs right now? You're right, we've seen a very strong last few weeks, particularly in the United States, particularly in the healthcare sector. We expect those conditions to continue, but a broader rally and deepening of the markets, I think, relies on some of those other factors.
Has there been a structural shift because of what's developing in private markets that's maybe holding back companies, and basically they've decided they don't need to go public in quite the same way they perhaps needed to decades ago?
I think there has been a shift over decades, and the growth of private markets, not just here in the United States, but around the world, give alternative capital formation opportunities. And you've seen, I think the US is the standout in terms of the public market still being deep, liquid, accepting, very strong following in sectors with multiple comparables. You go elsewhere around the world, UK, for example, very challenging in terms of the number of companies either leaving exchanges, moving to the United States, or not coming to market, and with IPO levels being very significantly down.
Speaking of which, I have to go there. Zeekr came to market in the U.S., in New York, which is basically an offset of Geely, right? This electric vehicle maker in China did really well. And it just raises this larger question of, do you still see the same degree of cross-border IPOs of companies, not just in China, but other places coming to New York? How much are people concerned about some of the geopolitics behind it versus, hey, a lot of people have money, let's go?
I think it's not just a lot of people have money, but it's also just the depth and quality of the US capital markets. I mean, it is gapping and it is significantly ahead of the rest of the world. If you go around, I've mentioned the UK, but also the European markets are not as deep as they need to be. Asian markets the same. So I think it's that just continued attraction of the quality of the equity capital markets here in the US.
Is there a rival at this point? We were hearing a lot from Paris. You buying that? John talking to David Solomon, Brian Moynihan, talking about building out in Paris. It's looking better and better from every point of view.
It was Macron doing the selling. Let's be clear about
They were doing the
All
buying.
right,
So
sure.
Are you doing the buying too?
Particularly in Europe, I'll say that Europe is the place that has to do the most structural change post-Brexit. Because they need to build capital markets. And as you know, they've been trying to build capital markets and banking union for many, many years now. And what you're seeing, I think, in France, in the Netherlands, to a certain extent in Germany, is member states realizing that they need to deepen their independent capital markets before there can be an EU layer created. There is too many impediments. And so what President Macron is talking about is absolutely sensible. And yes, Paris will grow, the markets will deepen, but I don't think, as to your question, will be a competitor to the United States.
What does that mean for your regional footprint as Citi? Where do you want to be located? Where do you want to boost staff, pull back on staff, given those forces that we've just discussed?
Well, we follow clients. And so we're talking about an IPO market. It's obviously a very narrow bit of what we do. So our network remains, we operate in over 160 countries around the world, and we continue to see broad opportunity in all of those regions that we operate in. So no dilution. Of course, there'll be at different times different areas of more positive growth. Again, I come back to the US being, with the characteristics of not just economic, but innovation and some of the stimulus that's happening here. Europe, cautious, but many European clients see that as an opportunity to take their own business models outside of Europe.
Do you think the US policymakers risk undermining the exceptionalism that we talk about every day on programs like this with some of the decisions that they're making? And I'm thinking more broadly, perhaps more narrowly actually, around things like M&A. Being unable to really know with any real clarity what kind of deal can get done in this economy with this White House.
Yeah, I would make a comment that the governments clearly need to look at policy, particularly in terms of foreign direct investment in sensitive industries and other things. That's always been present and will always be a factor. So I wouldn't sort of point to one administrative decision, but if you're involved in cross-border M&A and you want to invest in a market, it's a factor that you have to have examined. Whether you're in the tech sector, defence sector, banking, whatever it might be, you need to have that really considered carefully.
To John's point, as you travel around, you hear from clients, how concerned are they about policies that may change drastically next year, depending on a change at the White House?
They're all asking the question. They're all asking, who's going to win and what will be the policy setting, and that's very sensible. Though, of course, the news announced yesterday in terms of the tariffs that the US is imposing may indicate that actually policy differential won't be that great depending on who's in the White House. Of course, that's just speculation. But I think looking through that, it's really the volatility in the second half of this year that a lot of investor clients are looking at. And on the corporate strategic side, I think people just want to see a little bit more certainty. I'll talk about that range of potential outcomes on monetary policy around the world. but they want to see a little bit more certainty in the fiscal situation and also that policy setting. So they're not making big decisions necessarily leading into the election, but they want to be as informed as possible about what it might be straight after.
How are you preparing, given the fact that you've got clients in a lot of different countries, potentially even in China, at a time where we're going to get potentially a big disruption? How is that informing some of the restructuring that Citi has done in terms of not just the footprint and where you are, but how you are arranging your suite of products?
So nothing about our reorganisation, not restructuring, but nothing about our reorganisation that we've executed over the last number of months is to do on our geographic footprint. Indeed, we've reconfirmed the importance of our sort of global network and footprint. So what we have done, though, is sharpened our ability and our focus of our businesses and also the capabilities that we have to address clients' needs is make sure that they're directed very clearly towards the client. So where that network, that footprint, and so on, and that product set remains unchanged from what we had previously.
So you said that the reorganization has been largely completed, and yet there have been a number of recent exits, and I'm wondering how difficult it is to really retain some of the top talent at a time of churn, of change, which is always tough.
It is tough. I'd say that what we announced yesterday in terms of two senior retirements of T.D. Cole and Mike Whitaker, absolutely planned, all part of the execution that Jane Fraser, our CEO, had in mind. So this was normal and expected. But I'd go back and say, actually, our ability to attract very senior talent is high. Andy Sieg, who joined to run our wealth business, Tim Ryan, who we announced yesterday will be joining us as head of technology and business enablement. This is very, very high quality talent. There's Raghavan, who's joining us shortly to run our banking business. Top tier talent, attracted to Citi, attracted to the opportunity and the platform that we have.
What do you think changed? Do you think something has changed to attract that talent? Is it something as simple as the stock price performance, which is up more than 60% since the end of October? Because Citi stock, as you know, without being too critical, for a lot of people it's been dead money for a long time, starting to perform. Is that attracting talent? What is it that's changed for you?
I think you need to go well above the share price for that. I think it's clarity of strategy, and I think our chief executive has set out a very clear strategy, made some very clear decisions in 2021 in terms of some of the business activities that we would discontinue, and being really clear through this reorganisation that of the accountability that she wants the businesses to have but also to perform, and that I think is the factor which is attracting this talent.
Language is important. You keep saying reorganisation. What is the difference? Just help me understand between a reorg and a restructuring.
I think restructuring implies that you're changing fundamentally your business mix. Also implies that you might be sort of divesting in certain things. It's not. We've had a management reorganisation, so our structure catches up with our strategy, and we have a much simpler management structure than we had previously.
Seems to be paying off big time based on the share price performance, because that's what I focus on. Citi's up this morning, or rather down just a little bit, but over the last 6 months or so, pretty phenomenal price action there. David, thank you, sir.
Thanks,
Good to see you. Thank you very much. David Livingstone there of Citi. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Some of Japan's biggest banks say that they'll be seeing record profits this year. MUFG, Mizuho, SMFG all predict profits of over $21 billion taken all together. The banks expect earnings to grow thanks to strong loan demand. They also see an earnings boost from the BOJ's shift away from negative rates. Let's get a quick check on Burberry shares in London, trading lower more than 3.5%. The company warned of a challenging first half on weak U.S. and China demand. Now, the label has been trying to engineer a turnaround, but those efforts have run headfirst into cooling demand for brands that find themselves in the middle of the luxury market. For example, Gucci owner Kering has been struggling, while the more exclusive brands like Hermes have shown resilience. And the meme stock revival, it's finally taking a bit of a break this week. We're down pre-market 12% and 10% for GameStop and AMC respectively, though not only after GameStop alone added $9.5 billion in market cap in just 48 hours. That rally was driven by the return of Keith Gill, aka Roaring Kitty, on social media. But it's gotten to the point where even the former bond king, Bill Gross, has strayed very far from the staid world of debt to trade meme stocks. Specifically, he's been selling option straddles that he described on X as 400% annualized volatility. That's your Bloomberg brief, John.
Danny, thank you. We'll catch up with Danny in about 30 minutes' time. Up next on the programme, inflation data on deck.
if we get any sort of deviation to the upside, I don't think it brings back the idea of hiking, but it takes off the cuts, it pushes them back further. Rates can get really volatile today if we get an upside surprise.
8:30 Eastern Time, we're all waiting for it. Inflation data just around the corner. Live from New York, this is Bloomberg. Equities are doing absolutely nothing. Nothing. Stay tuned for 8:30 when they might do something. Futures are going absolutely nowhere on the S&P 500. Yields are lower by 2 or 3 basis points on a 10-year 441.20. Under surveillance this morning. Inflation data on deck.
The market is in, as I said, very confident going into this number. If we get any sort of deviation to the upside, I don't think it brings back the idea of hiking, but it takes off the cuts, it pushes them back further. Remember, the last few big upside surprises, we've seen like 15, 20 basis points move on a day. So rates can get really volatile today if we get an upside surprise.
It's been very messy over the last few months. Here's the latest this morning. Treasury yields ticking lower ahead of the US CPI print at 8:30 Eastern Time. BMO's Ian Lyngen writing this. Stronger inflation numbers will be far more bond bearish than a consensus print would be bullish. That said, we still suspect that a 0.3% core CPI print would initially trigger a bull steepening, albeit in range for the 2 to 10 curve. Ian joins us now for more. Ian, just develop that a little bit more, because that runs counter to what we've been told over the previous few weeks going into data, where people would say that risks are skewed asymmetrically to lower yields. Why is it the other way around for you?
I think to a large extent that the price action of the last week and a half has reset the market's expectations for what it would take to get 10-year yields to, say, let's call it 430 or 425. We would need to see a 0.2 on core or lower. Right now, we priced in a relatively benign takeaway from the CPI data, and the onus is on the realized data and maybe even retail sales to drive the market further.
So, Ian, that's on the 10-year. Could we just go a little bit further forward to the front end of the curve and sit on the 2-year? How capped is the upside there, given the reluctance of this Federal Reserve to raise interest rates?
I think there's very little chance that we go back to 5% 2-year yields. If we do, it's a buy-in opportunity because Powell took a rate hike off the table. And if rate cuts get delayed, that will simply keep the front end of the market from rallying, as opposed to push rates to a defined higher plateau from here. So I would think anything that gets us close to 4.95 or 5% will very quickly trigger buying interest.
Ian, this is something we've been playing around with. How much does that alone, the idea that it's somewhat pinned in terms of the upside on short-term rates, how much fuel does that give to the rally that we've seen in longer-term bonds? You say that you actually question that. At the same time, that stability, that certainty has been enough so far to really fuel a lot of risk appetite, especially in the bond space.
I think that is part of what's going on, i.e. the longer-term assumptions for how high monetary policy rates can go. But also, let us not forget, we recently heard from the Treasury Department, and they said that they have no intention to increase auction sizes for at least several quarters, which puts us into 2025 before we start worrying about supply again. So I think that's part of it. And then the jobs figures, they've been less great, not bad, but that combined with Powell's refocus on the employment part of the dual mandate has shifted investors' thinking about adding duration here.
With respect to the long end, are you viewing potentially a sell-off, at least in the near term, as stemming from just positioning? That people have gotten a little bit overly excited about the pace of disinflation and reintroducing even the chance of a July rate cut, and you think that that's premature?
Yes, I think that's a very good way to characterize it. I think that the market sentiment has swung too far in one direction, and without further confirmation from the data, we will retrace back into the range that we were in throughout much of this year.
When we talk about the potential for auctions and supply and the different dynamic, it raises a question about what kind of reaction there would be to retail sales coming in lighter than expected. To me, this is actually in some ways the bigger mystery than CPI that's been dissected again and again, and goes to this question of stagflation light, stagflationary winds, whatever you want to call it. How closely are you watching that? And does a softer print really give that rally into the bond market, especially if it's paired with basically an inline print on CPI?
if we get an as expected CPI number, even something within the range on headline, but that 0.3 on core, I think all focus will very quickly shift to retail sales. And keep in mind that retail sales is not an inflation adjusted number. So it will be difficult for that to materially surprise on the downside. But when we think about the pace of consumption during the first quarter and the softening in the labor market, it follows intuitively that people will start to become nervous that we're finally beginning to see the anticipated impact of a restrictive monetary policy that's been in place for several quarters.
You're talking about potential cracks in the labor market. We had the Michigan survey on Friday, the New York Fed report on Monday. There's serious concerns, at least when you look at the sentiment of consumers. Do you yet see them starting to withhold some of that spending?
Well, we haven't seen it flow through to the data yet. And I think that that's the biggest concern is people are starting to increase credit card utilization. People are starting to make fewer on-time payments. We're starting to see defaults increase. All of that suggests that there is some evidence that we're seeing a bit of a slowdown, but it hasn't made it through to the aggregate data yet. And I think to a large extent, that's why the retail sales print this morning could be such a wild card.
Ian, this is interesting, and I want to build on it. I want to ask you as a bond guy to talk about the equities just a little bit. Just sort of go with me if we can. A lot of people in equity markets are taking comfort from the idea that it doesn't matter how high inflation might be, how strong data might be, this Federal Reserve won't entertain another rate hike. And they see that as bullish. They take comfort from that. Even if we get an upside surprise on CPI a little bit later this morning, there will be people who want to buy that dip if we get one because of that very reason. Ian, what are the limits of taking comfort from that? Do you think we get to a point where high for longer is just as big a problem as entertaining the idea of an interest rate hike?
My biggest concern when it comes to the equity market is what it has been doing for financial conditions. It's been making financial conditions easier, which means that the Fed's runway to start cutting should be longer. And that becomes problematic when you think about it in the context of the wealth effect and the potential for the wealth effect and people's comfort with the amount of savings that they have actually driving inflation as opposed to being a reason to save because you're getting more of a return. So I think that that's one of the biggest kind of oddities of this cycle is that stocks actually haven't retraced despite what the Fed has been doing. So I would be a bit cautious, especially if we have another material leg higher in equities.
Why do you think Chairman Powell doesn't share that view?
I think that he's worried about the wealth effect. And to some extent, I think that he has really doubled down on this idea that he can pull off a soft landing or a no landing quasi-Goldilocks scenario, and it would be great for his legacy as chair. It would be great for what this implies for 2025 and 2026. So if he can pull it off, if he can begin cutting rates and reassure the equity market and reassure business leaders that we won't be restricted forever. And I think that that is an ideal outcome for the real economy as well as for the Fed.
Given what you've just said, how serious should we take him about getting inflation back to target if legacy is everything and he doesn't want a recession? Are we also saying that maybe that pain speech back in Jackson Hole in 2022 wasn't a real deal?
I think that he believed at that moment that the real economy was risking suffering more pain. And I do think that above all, the Fed understands that reestablishing price stability is key. They're holding the 2% inflation target. It's now in the FOMC statement 4 times, and that's very telling. They're not giving up the 2% inflation target. And that part of Powell's legacy is a lot more important than avoiding a recession. But if he can have both, I think that's a win-win.
In final one, September, still the date in the diary for you?
I think it's most likely. It might change at 8:31, but for the time being, I think September, December.
I'll ping you a message at 8:31. Ian Lyngen, thank you, sir, of BMO, breaking down this market for us, both bonds and stocks, and what he's looking for from Chairman Powell later this year.
Well, you've raised this question of why is it the financial conditions matter only when stocks are selling off, but they don't matter when stocks are rallying, which is essentially what we're dealing with the Federal Reserve. And the answer is, who knows, right?
We don't have one.
We don't have an answer. It's basically he wants to preserve a legacy of soft landing. And, frankly, a rally in the market isn't going to necessarily challenge that. It's once people are struggling to understand. But right now, the market is still buying Powell because you're not seeing longer run inflation expectations run away.
Credit to Ian and credit to Powell, of course. Going back to 2022, there was a belief that you needed pain to get inflation down. Inflation has come down a lot without much pain, seduced by the idea that maybe that would continue. Are we going to flip back at some point to the belief that to achieve that inflation target of 2%, pain might actually be required?
This is my fear, actually. And this is the reason why stagflation was something that people were so worried about. But my fear is that still people are saying, OK, now finally we're going to get disinflation. It was just delayed. If that doesn't happen, how much do people start to really think about a higher inflationary environment? If it does happen and we get retail sales that also underperforms, how much do people say, wait a second, maybe things are slowing down in a more material way, and that's the reason why we're seeing inflation tick lower in a more substantial way.
Big 60 minutes coming up. Here's the lineup. Ed Yardeni of Yardeni Research, David Kelly of JPMorgan Asset Management, PGIM's Tom Porcelli. We are 34 minutes away from US retail sales and CPI. From New York, this is Bloomberg.
The consumer is starting to say that these prices are becoming, somewhat problematic.
The consumer has softened a little bit, which, makes some sense given all the pressures that are out there.
The one thing that's maybe causing people to go home are these whiffs of stagflation that we keep seeing.
The biggest tail risk is inflation, and if inflation spikes higher, that's the big risk.
The CPI data, I think, are going to show this continued trend that disinflation has stalled.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is what it's all about. 30 minutes away from US inflation data together with retail sales. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. 8:30 Eastern Time. They are the two data points to watch. This just dropped from Citi and Andrew Hollenhorst. Do not forget retail sales. Andrew saying this: we expect soft retail sales control group to show consumer demand is slowing and why they think this Fed leader is on track for a cut in July.
This is really the key point here. If we get an inline print for CPI, which is expected, as we just heard from Ian Lyngen, off focus goes to retail sales. If it comes in softer than expected, the bias will be back on the economy, given the fact that this is a Fed that really wants to see that soft landing.
And then you get the Fed speak, and you'll hear from some hawks. Governor Bowman, Kashkari of the Minneapolis Federal Reserve. It's going to be interesting to see how they respond to that data that drops in 29 minutes.
Potentially, it'll be what we've heard from them before, and they'll echo that maybe we won't see any rate cuts this year. I love Andrew Hollenhorst this morning, though. Also important retail sales. Ian Lyngen just said to us in the last hour that they haven't yet seen in the data this lack of willingness yet from consumers to spend. But what we've seen in sentiment is that consumers are starting to get concerned.
Let's get to the scores. Equities right now just about unchanged. Take a look at this board. A total snooze. In the equity market, going nowhere. In the bond market, going somewhere. We're down 2 or 3 basis points on a 10-year. 4.4140. I think this is the definition, Lisa, of treading water in the stock market.
Yeah, you missed it. Yesterday we were treading water too, and the day before, guess what? Treading water also. Although at the end of the day, it was not treading water. It was like a sudden rally, and everyone was sending messages. What's going on? What's fueling this rally?
It's leaked.
It was leaked. It was a whisper number. It's going to come in light. Basically, people are looking for an excuse to rally, and that, I think, is how we're set up for today's data.
I love how those rumors start. You get a move, and everyone's like, it's leaked, and they start buying it.
It was hilarious. What's the whisper number? It must mean that people hear something.
It's in that GameStop as well, right?
Well,
it's like,
come on.
what does it mean?
It's
I'm going to buy it just in case it means something.
Okay, you think so? You watch Roaring Katie?
It's a great case study for the broader market.
Is it?
No, as I often say, I say this a lot, just because you found a casino doesn't mean you're in Las Vegas. It just means you found a casino, maybe a roulette table. It doesn't mean the whole thing is an institution dedicated to gambling. This is a serious business, Brennan.
Who are you talking to?
Friends,
I have no idea, but carry on. It sounds beautiful.
Connecting with the audience, all right?
Carry on, keep going.
Coming up in the next 60 minutes, Ed Yardeni of Yardeni Research, as global stocks rally ahead of US inflation data, and JPMorgan's David Kelly together with Tom Porcelli reacting to CPI and retail sales data, which is just around the corner. We begin with our top story. Global stocks rallying ahead of key data due out in just a moment. Ed Yardeni of Yardeni Research weighing in on the state of the consumer, writing, quote, there is mounting chatter that the consumer is cracking. We aren't cracking. They continue to predict that consumer spending will grow and so will the economy. That's our story. We're sticking with it. Ed joins us now for more. Ed, good morning to you.
Good morning.
What do you say to the consumer confidence reads that say things are bad, terrible, and getting worse?
Well, you know, Americans are extraordinary. When we're happy, we go shopping. When we're depressed, we go shopping even more. But I think consumers are still shopping, and I don't think they're dropping. And I do expect retail sales is going to be on the weak side because we had some weak income numbers for the month. But that's retail sales, that's merchandise, and people are spending a tremendous amount on services. I mean, getting through airports these days is just a real pain. Everybody's traveling, getting into restaurants is difficult. All the baby boomers are retiring and they're having fun.
Particularly Terminal 4 at JFK, which is absolutely awful.
Well,
yeah.
Can I say, I hate Clear.
Awful.
The whole thing. It basically is this
I
rigged
stopped
system.
it. I'm just doing TSA.
Clear helps you at some terminals, doesn't help you at others.
But it's pay to play. Otherwise, they go in front of you. Carry on. No,
Clear with TSA pre-check is pretty quick. Okay.
Yeah.
I went TSA pre, believe me. Very long line. Got things to say about Terminal 4, which I'll save for another day. Ed, are you saying that if we get a disappointment at 8:30 Eastern on retail sales, not to read too much into it?
Absolutely. I mean, we know that consumers went on a buying binge for goods once we got freed from the lockdowns during the pandemic. And we all wanted to, get some fun, do some shopping after the lockdowns, but we couldn't do it in services, so it was a big buying binge for goods. And that lasted, I figure, until early 2021, about March, was when the services started to open up. And we've seen a tremendous amount of spending on services. So, yeah, it's a month-to-month kind of number. I do expect it'll be on the weak side, but I think it'll be offset by services.
The Yardeni household sounds like a lot of fun. It's like sad, buy, happy, buy. I'm curious, though, about some of the conflicting data. We have Bank of America credit card data that shows actually an increase in spending with all the different income brackets.
Right.
Citi credit card data showing the opposite, actually showing some sort of disdain. There's discussion around a shrinking pile of savings and what that might do. What's your lodestar at a time where everything is sending a different story depending on where you look?
Well, I'm a card-carrying member of the baby boom generation, and a lot of my friends are retiring. I'm still working for a living because I had 5 kids, so I'm still supporting a few of them. But the baby boomers are retiring. Many of them only had 2 kids. The kids are adults. And what are their baby boomers doing? They're spending their retirement money. So they don't really need to spend on credit other than just for convenience, and then they pay it off.
So a lot of people are looking for confirmation of either a Goldilocks slowdown or potentially in a negative situation, stagflation. If we see, for example, a disappointing retail sales number and you see stickier CPI, even comes in above where we are, why should people dismiss that and not talk about stagflation at a time when it makes logical sense why that would happen?
Well, I'm in the same camp as Fed Chair Jerome Powell. I think in his press conference he said something like, there's no stag and there's no inflation. So I can agree with that. Economy is doing fine, and I think inflation is on its way to 2% by the end of the year. I mean, the CPI, excluding shelter, and by the way, I always take out what doesn't support my story. But,
we all do. Carry on.
But I'm
so
taking,
does the chairman.
Fair point. But I take out shelter, and we got a two handle on the CPI. I think you'll see the same thing today, and I think the shelter inflation rate's coming down. As we all know, it's kind of a bizarre component of the CPI. So I don't see stag, I don't see inflation. I see the economy doing quite well, and the stock market seems to be on board with that.
Yeah, and a lot of people see that continuing. There is this question just in a larger picture. You talk about the roaring 2020s, how much of it's being fueled by industrial policy, frankly, and this incredible investment in bringing back manufacturing. How much is that something that you want to ride in, for example, the copper rally, as well as the equity rally? How much are you seeing it sort of priced into stocks and now being priced in more to other areas that might be a little more inflationary down the line? Yeah,
well, the roaring 2020s scenario, I think, started to get discounted by the stock market on November 30th, 2022. That's when OpenAI introduced ChatGPT. And ever since then, investors have been looking for ways to play artificial intelligence. And they did that first with NVIDIA. And then just a few days ago or a few weeks ago, we started a utility rally. So all of a sudden, utilities are plays on the power play on AI. And now copper has been going straight up. So I think it all is the market's way of validating that things are actually looking pretty good, that a lot of people are making bets that AI is going to be an important source of productivity, and I think it will be.
But you lean into that. There's more to go.
Yeah, I think there's more to go.
When it comes to the consumer, you say that they keep shopping, but the Michigan survey sentiment is very low.
Right.
Also, the New York Fed report says that inflation, their concerns, their inflation expectations are much higher.
Right.
How do you make sense of the two?
Well, the Consumer Sentiment Index is very much influenced, it reflects inflation much more than the Consumer Confidence Index, which reflects more employment. And so I think people are kind of still annoyed, very annoyed, that prices are much higher than they were before the pandemic or even a couple of years ago. But a lot of the sensitivity of the Consumer Sentiment Index, the Michigan survey, is in fact gasoline. It's the most widely seen price that you pass it every day. And so the price of gasoline has been coming down over the past couple of weeks. I think that'll continue to be the case. The main reason it went up a few weeks ago was because of all the geopolitical risk. But the price of oil has actually been coming down, and so has gasoline prices. So I think that'll relieve some of that.
Ed, I'm happy to say you're going to be sticking with us. Ed Yardeni, looking ahead to the Roaring '20s. I mentioned this in a commercial break. You don't see the commercial break. I was thinking about this last night. It's 2025 next year. We're halfway through Ed's call of the Roaring 2020s.
And guess what? So far, it's been right. And frankly, it has been sort of turbocharged from 2022. The legs, the tentacles of this is what I'm wondering. And when we were talking with Evan Brown about the widening out of the exceptionalism of the U.S., how much of that is because everyone's getting on board with investing in industrialization, and that's essentially fueling the copper plays and the utilities plays, et cetera.
We can talk about this in a moment, but the sector composition interests me. We used to think about tech as purely offensive, and then there became this sort of defensive secular trend involved as well. So people used to start talking about it being defensive, and now utilities, typically defensive, but now offensive because it's tied to the AI theme. I can't keep up. I'm not sure what part of the market is for what anymore.
Yeah, what's growth? What's value?
Right.
I mean, honestly, all of these names, the different factors are getting more and more muddied as we get further along. You're right to say about utilities. Is that almost an aggressive play on AI? How many people do you hear about that? Going to small towns, can you build out infrastructure, utility shop, cool some of the
data centers?
The data centers.
Oh, yeah.
I find that so interesting.
I know, from a real estate perspective too.
Yeah.
Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Speaking of AI, Google Glass may be set for a comeback thanks to artificial intelligence. At the company's annual developer conference, Google unveiled Project Astra. It's a new AI assistant that can theoretically react to the world like people do, responding in real time to what it sees and hears through a smartphone. Now, a video during the event showed a pair of glasses with a built-in camera and visual interface. Executives confirmed that they're experimenting with the idea of making glasses for Project Astra. OpenAI's chief scientist and co-founder Ilya Sutskever is leaving the company. There had been months of speculation about his future after he had played a role in the brief ouster of Sam Altman last year. Sutskever had clashed with Altman on how rapidly to develop AI. OpenAI announced that he will be replaced by its research director, Jacob Pachoki. Now, a new potential buyer has emerged for TikTok's U.S. business. Real estate billionaire and former L.A. Dodgers owner Frank McCourt said that he plans to build a consortium in what he described as, quote, the people's bid. He joins a diverse group who expressed interest in buying the platform. That includes former U.S. Treasury Secretary Steve Mnuchin and former Google CEO Eric Schmidt. Now, whether or not any of them can actually buy TikTok is a completely different story. ByteDance, of course, has said it has no intentions of selling the asset. And that's your Bloomberg brief, John.
It's a minor detail, Danny. We'll catch up with Danny again in 30 minutes. Up next on the programme, the morning calls before we set the stage for CPI and retail sales. That's all coming up next. That conversation just around the corner from New York. This is Bloomberg. So here's the state of play going into CPI and retail sales, about 15 minutes away. Equities just a little bit negative. The emphasis again on a little bit. We're down by 0.02%. Yields are lower by 2 basis points. The 10-year 441.59. It's time now for the morning calls. First up, Morgan Stanley resuming coverage of ExxonMobil at overweight, seeing attractive growth after the acquisition of Pioneer. Next up, JPMorgan upgrading NEO to neutral. The analyst expecting shares to benefit from China's stimulus policy and higher auto demand. And finally, Bernstein upgrading General Mills to market perform, expecting a stronger second half of 24 and improving macro environment. All of that still to come. We're looking ahead to CPI and retail sales in about 14 minutes' time. Ed Yardeni is back with us around the table. Ed, we've been talking about defense and offense. I want to talk about which sectors to use to do what. We mentioned it before the commercial break. Utilities were almost exclusively defensive, and now there's seemingly this AI theme to it. Have things changed in the stock market?
Yeah, well, it's a moving target for sure. I mean, I'm sticking with what I've been promoting or recommending as overweights, and that's technology, industrials, and communication services. I think those continue to do well. But meanwhile, we're seeing a lot of materials are doing quite well. Copper-related stocks are doing extremely well. I think it's becoming a broad bull market. I think you just stay with it.
Early stages? A lot of people would say we're late cycle, getting towards the closing end of this.
I've got 5,400 on the S&P 500 by the end of this year or the end of this week. I'm still working on the timing.
Might be the end of this week.
Might be the end of this week, the way things are going. But then 6,000 next year and 6,500 by 2026. So that's a 25% increase from here. That's pretty reasonable. So I think my forecast is a sustainable long-term bull market.
Ed, you said in the break that the biggest risk right now is a melt-up.
Yeah.
And that any rate cuts by the Federal Reserve would be a huge mistake.
Right.
Why do you say that? Why would a rate cut fuel another leg higher that would be such a big mistake?
Well, the bull market is just constantly stampeding over my forecasts. I mean, last year I thought we'd get to 4,600 by the end of the year. We actually got to 4,800, and we got to 4,600 by the middle of last year. And here we're already at over 5,200. I thought we'd get to 5,400, which seemed like a pretty aggressive forecast. But now people are asking me, are you going to be raising your number here? So, look, I think that the concern I have is if the Fed really does start lowering interest rates, I mean, that could really create a melt-up. And that would be an issue for me.
We've been talking about this extensively, the idea that Fed Chair Powell doesn't seem to think that financial conditions are a problem when the market's going up, only when they're going down.
Right.
Why do you think that is?
Well, I can't really figure out what Powell's thinking, because he has been actually fairly dovish, while some of his colleagues have been more on the hawkish side. I think it makes more sense for the Fed to provide guidance that they're not quite sure that they've gotten inflation down, and that they're not only in no rush, but they're not necessarily, in the camp that interest rates have to come down. My view is that the Fed has actually normalized interest rates. This is where they should be. I don't think they should be thinking about bringing interest rates down aggressively, because the economy has demonstrated it can do just fine, and the stock market's doing just fine, and bond market's kind of hanging in there pretty well.
Ed, if Powell was to say that and claw back this idea of a rate cut this year, how bearish would that be for the market?
Well, I think the markets have already demonstrated that they can live with disappointments on the interest rate outlook. I mean, we started out the year with the markets thinking 6 to 7 rate cuts. I couldn't figure out where that was coming from, other than from all these people who thought we were going to have a recession for the past 2 years, and that was sort of their stealth way of saying we're not out of the woods yet. And there's still people talking about a possible recession here. But all in all, I think, if everything's working out well, why mess with it? And that if you should just say that, I think that would actually be reasonable and consistent with what the data has been showing.
It's clear to us, based on what you've said, that this 5,400 price target on the S&P is not dependent on Chairman Powell cutting at all this year. Is that fair?
Absolutely.
What could derail it?
Well, I think clearly if we get some continuation of some hot inflation news, that would be an issue. I don't think that's going to be the case. We'll see how the CPI comes out. I mean, every time we get a CPI, it's the most important CPI we've ever had in our lives.
Because it is, Ed. Don't kill it.
Yeah.
It is. The most important one until the next one and since
until
the last one.
Until the next one. And meanwhile, the market just kind of has learned to, take it all in stride and just keep going higher.
Are there limits to that? After 3 upside surprises this year, are there limits to that?
Well, certainly there's already people kind of thinking about the possibility that the Fed may have to consider raising interest rates. If that suddenly becomes a reality and they start talking about that, I think that would certainly be good for a 10% correction.
If you think that the biggest risk to your outlook actually is an upside melt-up, right, and that the biggest risk is that the Fed does cut rates and that is what ignites the rally,
right.
How much would this market rally if we get a July or September Fed rate cut?
Well, I mean, we'd blow right through 5,400 in a heartbeat, and then I think we could very well get to my 6,000 target for the end of next year by the end of this year. So, you know, I think the market, there's a tremendous amount of liquidity out there. $6 trillion in money market mutual funds. A lot of them are invested actually in repos instead of treasuries. So you put it all together and it could be a pretty powerful bull market.
This is a fascinating call when you put it together, that essentially a Fed rate cut, if there are no rate cuts, it doesn't affect your 5,400 call. If there are any rate cuts, that could significantly affect the call.
That's right.
Is that kind of where the market is right now? There is an asymmetric risk where essentially higher for longer doesn't make anyone worried, but rate cuts will turbocharge what we've seen.
Well, we've already seen that people are looking at this Citigroup Economic Surprise Index, and it's come down quite a bit, and that's actually been supportive to the bond market, and in turn, it's also been supportive to the stock market. Now, why would disappointing economic indicators be good for the stock market? Because the market would just love to see the Fed cut interest rates.
Yeah, and we've heard that again and again from a lot of people. Just quickly, you're looking for maybe a downside surprise on retail sales. CPI in 8 minutes, what are you looking for? 0.3, like everyone else?
Yeah, like everybody else. And gasoline prices may have boosted it, but they're going to reverse that next month.
Ed Yardeni of Yardeni Research, looking ahead to this economic data. 8 minutes away, standing by, Mike McKee, our economics and policy correspondent. Mike, what's the big focus for you, sir?
Well, we're going to start with housing to see if that Godot of economic indicators finally shows up and we get a decline in home prices, but also going to be looking at the insurance numbers. Remember, auto insurance in particular has been rising at a crazy rate, and so that has pushed up CPI quite a bit. Those are the important things, and we'll see then what Americans are buying with retail sales. It is a big drop that is foreseen in the retail sales core numbers, and that could make a big difference in the outlook for the second quarter.
Mike, just can you set the record straight? Yesterday, as we headed into the end of the day, the close of trading, there was actually a pretty substantial rally, and people were saying, why? And there was a rumor, as there are wont to be, that it was a whisper number that came out. Is that basically what you're hearing, that the guidance from a lot of people is that downside surprise that has been fueling a lot of this optimism?
I'm not sure that that's the case. I mean, people want to believe what they want to believe. The thing about the CPI is that most people get that right. Most economists get that right. It's fairly easy to figure out compared with retail sales, which are constantly heavily revised. So the retail sales would be based more on anecdotal feeling, while the CPI is probably based more on Excel spreadsheets.
Mike, what's so important for you under the hood in the CPI report that trickles down into PCE?
Well, you're going to be looking at hospital and medical care, especially for social work medical care, and we'll be looking at insurance and airfares. But the big thing that has moved the PCE is the portfolio management category, which was up a lot in the PPI. We'll see how it comes out in CPI.
Mike, it's amazing. Some people reacting to that, asking why on earth it's in there. Typically, we refer to PPI as factory gate inflation. What on earth is that doing there?
Well, it's calculated different ways. One is how much people pay for the services, like if you were paying Ed Yardeni for his services. And then the PPI is looking at what Ed Yardeni is charging for those services. So there may be a kind of a difference. There's also some methodological issues.
Mike, before you go, I want to look ahead to the Fed speak as well. We'll hear from Kashkari, who's open to the idea of not cutting at all this year. Governor Mickey Bowman, someone you've followed a lot, who's basically told us she doesn't think we will cut this year. How much company do you think those two are going to get on the FOMC in the upcoming meeting?
I don't think we get a huge amount. Jeff Schmidt from the Kansas City Fed said last night, it's not one number. The market will focus on one number, and Kashkari and Bowman will get a lot of ink. if we do get a surprise to the upside, and it makes it look like we're going to push out rate cuts. So they'll get a lot of talk, but I don't think it'll have a huge impact yet. It will have a big impact on the markets, given the dearth of other numbers other than PCE at the end of the month before the next Fed meeting.
True, and it always does. Mike, stay close. Mike McKee, 5 minutes away from breaking down economic data for you. There is not just one number, there is many. I can tell you on the Bloomberg terminal, there's like 15. Loads of CPI readings, a lot of retail sales. All of that is just around the corner. We'll break things down with Mike McKee, get reaction from him, and then a first-class lineup for you. David Kelly of JPMorgan Asset Management, Tom Porcelli of PGIM, responding to that data dropping in about 4 minutes' time. Equity futures treading water, live from New York. The data up next. Hey, this is what you've been waiting for. Retail sales, CPI data just around the corner, the scores going into it. And the equity market on the S&P 500 totally unchanged. In the bond market, a 2-year, 10-year, 30-year shaping up as follows. The 2-year, 477.65. Bear in mind, last time we got a CPI print, upside surprise, saw a move of more than 20 basis points at the front end of the curve. With your economic data this morning, here's Mike McKee.
Well, we're waiting for the numbers to drop, and they've just fallen, and we have a downside surprise to CPI. Comes in up 0.3%, as does the core rate for the month. So that pushes the year-over-year CPI to 3.4% from 3.5%, and ex-food and energy, the core, to 3.6% from 3.8%. So an inflation story that is good news for the Fed for once. Everybody react in the bond market, please. Retail sales come in little weaker than expected, 0.0%. Last month revised down to 0.6%. Ex-autos, 0.2% from 0.9. The core group, which is what we really care about, is down 0.3% after a 1% rise the month before. So at this point, what we're looking at is a economy that seems to be slowing down, consumer spending slowing, but prices dropping at the same time, which could be a recipe for Fed rate cuts if you want to hurry up and overreact.
And the market reacting to it, Mike McKee. Not for me to say they're overreacting, but certainly reacting to it. We often say the first move isn't always the right move, but this is certainly the initial move. Equity futures positive by 0.6% on the S&P, the Nasdaq moving higher by a similar amount. On the Russell, up by 1.5%. And you can say thank you to the bond market. Switch up the board. In the bond market right now, double-digit move at the front end, lower by 10 basis points on a 2-year to 471.32. We're down by 10 basis points as well on a US 10-year to 433.61. If you turn to foreign exchange, you can guess what the euro is doing against the US dollar. The euro is stronger by 0.5% at about 108.69. Congratulations to the 63 of 68 people surveyed in our Bloomberg survey for CPI, Lisa, looking for 0.3 on core, and 0.3 is what they got.
They got it exactly on the dot, and frankly, this is the rally that everybody was expecting as well. As we pointed out, about 49% of people who were surveyed by 22V Research expected just this result. Question that I have is, though, where does retail sales fall into that, given the fact that when you take a look at some of the control groups, the control group in particular, down 0.3% versus a gain of 0.1%. When is that not positive necessarily to the momentum of where this is going?
That's retail sales. CPI, if you are just joining us, headline month over month coming in at 0.3. The estimate in our survey 0.4. The previous read 0.4. Stripping out food and energy, we get 0.3% against an estimate of 0.3 and a previous number 0.4. Mike McKee, as you lift the lid on the headline stuff and get into the detail, what stands out for you?
Well, we did not get a big drop as we had hoped in terms of the owner's equivalent rent and the real estate portion of CPI. Owner's equivalent rent comes in up 0.4, which is the same as it has been for the last several months. Rent of shelter comes in at 0.4%. So no real change there. Gasoline prices were up 2.8%. Food, though, was flat on the month, so that contributes to a slightly smaller impact overall. I'll keep looking through those numbers and get you some more. Taking a look at the retail sales numbers, it looks at this point like motor vehicles really made a difference, down 0.8%. So that subtracted a lot from the top line number. Other than that, sporting goods down 0.9, but clothing up 1.6%. Food and grocery stores up 0.6%. And the food services and drinking places, which is kind of the one services industry thing we get, is up 0.2%. So at this point, the weakness seems to be in areas that are not directly, not something people spend a lot of money on a regular basis. You don't buy a car every day, but the things that people were spending money on still saw increases. So I'll let the smarter people analyze all that.
As we put it together, what we're seeing in markets is basically almost a full pricing of a September rate cut as people bring forward the idea that this is the disinflation that so many people have been looking for. You took out owner's equivalent rent. Is that essentially what a lot of people are doing at this point? We heard from Ed Yardeni just now. He cuts that out. A lot of people saying that's noise, focus on the other. Is that what we hear on the Fed as well?
Well, that's kind of what the Fed is going to do. They know that the numbers are lagged in terms of housing, and so they know it's going to take a while for that to come down. It's taken a lot longer than they anticipated, but it isn't really representative of what overall inflation is doing, which is kind of why Jay Powell brought up the supercore. Supercore does rise on a year-over-year basis and a month-over-month basis. Let's see what we get, 0.42, which is down on a month-over-month basis, up a little bit year-over-year. But the supercore, which takes out housing, does show some progress in terms of services inflation.
Mike McKee, thank you, sir. Stay close. We'll come back to you. 9:35 p.m. in Tokyo, Japan. Raise a glass to the Ministry of Finance. I'm sure they're happy with this. We're down about 0.8% on dollar yen, 155.20. Down 0.8%. A stronger Japanese yen, a weaker US dollar. If you are just joining us, the data shaping up as follows. 0.3%, the headline number. The estimate was 0.4. Looking at core, stripping out food, stripping out energy, 0.3. The estimate was 0.3. Equities are higher. Bond yields are lower. The dollar's weaker. We've got a stacked table here in New York. David Kelly of JPMorgan Asset Management. Tom Porcelli of PGIM Fixed Income. Gents, good morning to you. David, first to you, your reaction.
Well, I think what we've got is a moderation in the U.S. economy, both in terms of growth and inflation. Inflation it's taking its sweet time coming down, but we still think it's a downward trend. And I think, the reason for the market reaction is that we didn't get an upside surprise. So we've now had three reports. We've had the jobs report, then we had the consumer sentiment report, and now we've had the retail sales report. And they're all saying, overall things are moderating here. When you look at the JOLTS number, things are moderating. We've got fewer job openings. So it looks like the economy is just easing itself into sort of a 2% corridor of 2% growth, inflation gradually coming down towards 2%. And that's very good news. And I think the good news is that we didn't get another upside surprise in CPI today.
Does that whisper of a July cut grow a little bit louder after this, or is July still too soon?
I don't know if the whisper, it's already been a whisper. I don't know if it can become less of a whisper. I think it sort of stays where it is, which is to say, around 25%. I think that's probably reasonable. It doesn't go away, though. I think that's the important thing on the back of this. So I think it could probably still linger. But I think as a practical matter, it's probably going to get pushed a little bit, and I have no challenge with that. In fact, one of the things that I've been sort of critical of Powell when it's been mostly deserved. There's
no pushback around this table.
But recently, I think he's done a good job with the narrative, right? Like I think after the last presser, and actually the presser before, where he said, "Hey, look, we're not going to overreact to a couple of sort of strong string of inflation reports, just like we didn't overreact to a really soft string the last go around." So I think that this to me is a chair who wants to cut. I think that, and you can easily see one, and I think if he has the opening, I think he'll do two. And I think data like this, if it persists, I think that'll give him that opening. And sorry, I'll make this one last point, and I think sure. David rightly highlighted this. If you look at that control number on retail sales, it was pretty weak. And again, no one's making the case that we're sort of falling off a cliff here, but I think things are slowing down. And that would be consistent with the Fed having the ability to cut.
We were just speaking with Ed Yardeni, and he doesn't necessarily have the same kind of sanguine outlook that you do with respect to Jay Powell, because he says, honestly, the consumer is strong. That, there was weakness in the control group, but as Mike was saying, it has to do with auto sales. It's not the sort of broad-based people not going out and spending things. Yeah. So at what point, David, do you look at that and say, you know what, things are fine now. Why the rush to cut? I know you are in the please cut now, and you should have already cut camp. But why is it not that we see things are just fine and you should stay in here and only a cut would turbocharge a rally, which is exactly the reaction we're getting today?
Well, I think you should normalize interest rates. I think the Federal Reserve for a long time has been trying to micromanage the economy with rates that got too low and too high. I think it messes with financial markets. And, the more the Federal Reserve tease off financial markets, the more financial markets sort of act like sort of babies here. I mean, you shouldn't have had this much of a reaction. But you get this reaction because of the Federal Reserve is so sensitive about saying anything that might offend the markets one way or the other. When economic numbers are a little bit off one way or the other.
Isn't it fair to say their reaction function is set up for us to be hypersensitive to data?
Yeah, I mean, I think markets
have
an overreaction function. That's the problem. And so markets just overreact. And so the Federal Reserve, you kind of have to expose the markets to normal policy. Normal policy is if the economy is doing okay, rates ought to get back to normal levels. And I do think, I don't think July, but I do think September is possible. It's there. And I think Jay Powell himself will actually make a decision as he heads towards this about whether he wants it himself. Because the one thing that we've seen about Jay Powell, which is very clear, is he wants to build consensus and he works hard and actually lobbying. I wouldn't say lobbying necessarily is the right word, but he does.
It's a good word,
But he does talk. I think it's amazing that he talks to all 19 participants of the FOMC meeting before the meeting and just, this is my view and so forth. And that's why he's been able to get so much consensus. So if he thinks that, look, let's get going on a slow rate cut cycle before the election so we can, and let's get it going here so we can't be accused of playing politics. I think he might well do that in September.
Tom, you seem eager to weigh in.
No, I agree. I think David is completely spot on. Look, I think this is just a recalibration cycle. This is not, people hear cuts, and I think that immediately conjures up the images of the Fed like getting aggressive. Like, we don't think that that's the case. We think that this is going to be a sort of a very modest reduction in funds.
But talking about markets as babies, right? Yep. This question of how they react has been basically a feature, not a bug, of financial policy. Yeah. This was the transmission mechanism. We've been talking about this all show. How much do we get a rally on the idea that we're going to get a cut? And that's going to be a problem. It's going to set us back further and actually cause this to be more of a problem and more sticky.
Well, I think the Federal Reserve makes a big deal about how they don't allow politics overrule what they're doing. They should also do the same thing about market reaction. So they should not overreact to how the market reacts to either economic numbers or their own policy. But also, what they need to do is, and I completely agree with you on a recalibration here, because what they need to talk about is not monetary easing, but monetary normalization. The truth is, I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment. Yes. There's nothing wrong with 4.5% on a 10-year Treasury. That's actually about right, given a 2% inflation.
Normal for Fed funds?
I personally think normal for Fed funds is somewhere between 3.50 and 4. I mean, in the 50 years before the financial crisis, it was 2% above core CPI inflation. That would be 4 in the long run. I think, somewhere 3.75 to 4 would be about right.
No, I mean, I just found my new best friend.
It's love. Look at this. Carry on.
No, I think yes, I agree. I mean, I think I think that's exactly quite right. I think that this, to me, is. I think this is the right way of thinking about where we're going. I think 3.5% to 4% is probably the right range to consider this in. And the good thing about that is. That is roughly what the market is expecting. So I don't think that there has to be some big recalibration as it relates to the market, because expectations seem to be roughly right. Although the market has tended to take things way too far. Let's be honest on that.
We'll get to the market right now. Equity futures are positive off the back of this economic data. I know a few of you just tuning in. This is what you missed. 0.3% is the number for CPI. 0.4 was the estimate on a headline basis. Stripping out food and energy, 0.3 against an estimate of 0.3. The Russell outperforming. The small caps up by 1.4%. Thank you to the bond market. Treasuries rallying, yields dropping across the curve. The 2-year down about 7 basis points now to 4.74. Mike McKee still alongside us. Mike, you've had longer to read through this. What stands out now?
Well, a couple of the categories that people watch closely performed pretty much as expected in that used cars were down 1.4%. Insurance, health insurance only up 0.3%, but unfortunately, auto insurance still posting a big gain, 1.8%, down a little bit from last month, but still an outsized gain. And John, you had a probably good discount on your trip to Paris this week because airfares were down 0.8%, which is kind of interesting because the CPI CPI tends to include what people are buying for vacation time ahead. So we'll see if airline fares can continue to behave.
Just for the record, it was Taylor Swift weekend in Paris, and I booked the flight, I think, a day before I got it. So, Mike McKee, that was not cheap at all, just for the record.
Did you enjoy the concert?
I didn't get to watch the concert, but it was very busy. Can you imagine me at a Taylor Swift concert?
Yes.
Mohammed went.
I know.
Mohammed's going to be on the programme on Friday.
Bright pink. It was fantastic. He said it was amazing.
Did he really think he wouldn't be seen in that T-shirt?
All I know is he's now a Swiftie.
Mohammed's going to join us Friday for a review of the economic data and apparently a review of the Taylor Swift performance in Paris, France over the weekend. David Kelly, I want to come back to the Federal Reserve, certainly not on Taylor Swift. You've said repeatedly that the Federal Reserve should just have faith in the calendar. This is going to work itself out through the next 12 months, regardless of how restrictive they think they are. Is that still your stance?
Absolutely. I mean, if you look at airline fares, I mean, you know, we've actually got air travel back above pre-pandemic levels. There's plenty of demand out there, but the airline industry is competitive enough for airline fares to come down. But overall, you know, in some areas of services and throughout the goods industries, what we're seeing is enough competition to gradually push inflation down. So this is not an inflationary economy. The only time it's an inflationary economy is when you have a huge supply chain disruption and you have huge fiscal stimulus where you're giving money to low and middle income households. That is the one way you can generate significant inflation here. Once you take that away, inflation will gradually drift down, and that's exactly what it's doing. It's just very gradual.
Tom, do you think a lot of this market reaction, though, is actually the CPI or the retail sales? Because CPI is pretty much in line. Retail sales was much softer.
Yeah, I mean, you know, it could also be a sort of a better than feared, because as we were saying, I think before we were on camera, you know, this could have easily been a 4/10. So I think it could have been some of that for sure. You know, the thing too about inflation, so I just think, look, I don't know about the wisdom of stripping out an assortment of different things like, you know, supercore. I mean, you're stripping out 50% or more of the weight of inflation, which I have no problem stripping things out of inflation. But what I would say is if you want to do that, then I don't know, then go the next step, right? Because what we know is that auto insurance has been a thorn in the side of inflation. There's nothing the Fed can do about that. And if you strip that out, inflation looks even a little bit better. So to me, that's just keep in mind there are some idiosyncratic sort of sectors that are really impacting inflation that the Fed has no ability to control. And so in that context, I think it's an even better outcome.
And also, I mean, the Fed, for good reason, sets a target at 2%, but no economist will honestly tell you there's a big difference between 1 or 2 or 3. Exactly. You know, so long as you're there or thereabouts, you know, you're okay. And then what you do is do no evil. Do not distort financial markets by having rates at a significantly incorrect level.
So then should the Fed just be targeting 2 to 3%?
Well, in Canada, they have a range of 1 to 3%. And I kind of like the idea of a range of 1 to 3% as a target. We get in that range and we're fine.
I totally agree. In fact, I always use the RBA. I know, it's terrible. I'm sorry for you all.
Carry on.
We'll go for a drink. Start the weekend dirty.
Exactly. David's using Canada. I've used the RBA as a great example. And the RBA has a range. And I think a range is just saying 2.0% to me just strikes me as like the pinnacle of hubris. I mean, like, you rarely sit at 2.0% for any period of time. I think a range is really the right way of thinking about inflation.
And it actually caused tremendous problems last decade because they kept rates way too low for way too long as they were trying to get inflation up to that 2% target. Yep. And that fueled a lot of the asset bubbles and real estate bubbles that we're now suffering from.
So anyone who took the survey, the University of Michigan survey last Friday, who's listening to this says, what are they talking about? They're in Goldilocks land. Everything is amazing. It's going to be a great economy. Stocks are going to keep rallying. We can sustain this. Jay Powell is great. Where is the disconnect here between the idea?
Okay. Yeah, sorry. So it's an important idea. I think about like my parents, right, who haven't the foggiest idea what I do for a living. I mean, even after me trying to explain it to them. But you know, when I tell them, look, you know, inflation is, because they're always asking, what's happening with inflation? I'm like, oh, it's improving, you know, not to fear. And my father loves to say, like, what the hell are you talking about? He's like, I'm going to the store, I'm still paying a lot more for stuff. Mm-hmm. And that's the disconnect between Main Street and Wall Street. Like, we look at the percent change, and they look at price level terms. In price level terms, it's still incredibly elevated, and that's a problem, by the way, from a consumption perspective, because a lot of these things are fixed costs, like auto insurance or like food prices, that will actually continue to chew into disposable income.
Okay, that's been basically the theory.
I have to say, you need to fade that University of Michigan Sentiment Index surprise because they had a change in methodology. They're starting interviewing people on the web as opposed to on the phone. And apparently,
they don't call us anymore. I've been waiting for that call for ages. 500, 600 lucky people.
Well, yeah, exactly. Well, now you get asked on the web, and apparently you're more gloomy when you're looking at a screen.
David, how antiquated is calling someone on the phone?
Oh, no problem at all. But the problem is that they changed methodology. And they didn't do a level adjustment for the bias that they know it's actually causing their data. Right. They put something out. I mean, this is really technical, but just...
No, I love this
it's
Tell me
not...
More. What do they actually ask, and how do they filter out answers like, I think inflation's going to be 20%?
If they don't do a fix to this, the University of Michigan survey will be about 6.6 percentage or index points below where it was a few months ago forever. Right. So it just this change in methodology actually messes up the numbers. So I know everybody gets excited if a number misses consensus by a lot, and that happened. But it was just the technical
final
issue.
word, please.
Yeah, again, just to amplify. I mean, just keep in mind for whatever the confidence numbers are worth, confidence has been pretty downbeat. Yet spending has been pretty robust on a relative basis, right? So we're faders of the Michigan numbers too. But I think
we now.
Yeah, exactly. but I think the inflation expectation numbers within Michigan, I think, are really useful.
Sometimes it's nice to get along. Gents, this was great. Thank you. Tom Porcelli of PGIM alongside David Kelly of JPMorgan Asset Management. Equity futures here positive by 0.6% on the S&P 500. We've said a few times on this programme, inline is like the new beat for economic data. Inline on core, enough to trigger an upside surprise, or rather a rally in the equity market. Downside surprise on retail sales, maybe adding some fuel to that move. We're down at the front end of the yield curve on a 2-year by 9 basis points to about 473. Let's give an update on stories elsewhere. Let's cross over to Danny Berger with your Bloomberg brief. Hey, Danny.
Hey, John. Shareholders of BHP and Anglo American expect BHP to come back with one more sweetened bid. Anglo has twice rejected bids from BHP, but shareholders in both companies told Bloomberg that they think a third one is on its way before a May 22nd cutoff. Anglo, for its part, said it's going to exit diamonds, platinum, and coal to try to appease shareholders. BHP has said it will remain disciplined in its pursuit. Boeing may face criminal prosecution after the U.S. Justice Department said it violated an agreement tied to 2 deadly crashes 5 years ago. The $2.5 billion settlement reached in 2021 had allowed Boeing to avoid criminal charges. But according to a recent filing, Boeing breached it by, quote, failing to design, implement, and enforce compliance in preventing and detecting violations. Now Boeing has 4 weeks to respond before the next steps are decided. And Comcast, as many others, are betting on the return of the bundle. Comcast said it will offer a streaming package which will include Apple TV+, Netflix, and Peacock at a vastly reduced price. That's according to the CEO, Brian Roberts. The new bundle will be called Stream Saver, and it will be introduced later this month. That's your brief. John.
Danny, thank you. Appreciate it. Up next on the programme, setting you up for your day ahead from New York. This is Bloomberg. This right here, the recipe for a little bit of a rally in the equity market. The ingredients, retail sales a little softer than expected. CPI on headline coming in a little bit lower than expected, and core CPI coming in line at 0.3% against an estimate of 0.3% month over month. Equity futures positive by 0.5% on the S&P 500, and yields are lower by 9 basis points on a 10-year, 435.36. Here's the trading diary for the next 24 hours or so. A host of Fed speak from Barr, Kashkari and Bauman today, then Barr, Barkin, Harker, Mester and Bostic tomorrow. Plus another look at a consumer with Walmart reporting before the opening bell, followed by jobless claims. Bramo, final thought after that one this morning.
Honestly, it's this sort of dissonance between financial conditions when the stock market rallies not being a problem and when it falls being a problem for the Fed. Is this market basically saying a rate cut is going to be positive for stocks? Anything else is going to be neutral? Is Ed Yardeni right? And is the risk potentially for a further melt up?
3.6% annual inflation rate is the lowest in 3 years. So this is going to be welcome news, Jonathan, in the White House. This is a new factoid the president come out and talk about. There was an FT poll about 2 days ago, and this is what continuously is on top of mind of voters. High prices, biggest financial challenge for 80% of voters, and this is what is weighing down his poll numbers.
Is the calendar on his side? if we can see more of this through the rest of this year?
Does it even matter if it's really just a matter of the absolute values of things going up? I mean, it's been disinflation for a while. It hasn't really translated, and that's been the huge problem. How do you translate this story of glory on Wall Street to a Main Street that, at least in the sentiment survey that's been levied on the internet, that evidently is completely ineffective, is leading people feeling kind of sour?
Consumer sentiment speaks for itself. Right now, futures are positive by 0.5% on the S&P 500. Conversation continues through the day right here on Bloomberg Television. Coming up tomorrow on this programme, we'll catch up with Julian Emmanuel of Evercore, Mona Mahajan of Edward Jones, the brilliant Libby Cantrell of PIMCO, and Michelle Meyer of MasterCard. Looking forward to all of that. If you are just joining us, retail sales a little bit softer. We had CPI coming in line on core, and equities are doing all right. We're doing fine. We're positive by 0.5% on the S&P 500. In the bond market, yields are lower across the curve. On a 2-year, we're down 9 basis points to about 472. On a 10-year, we're down 9 basis points to about 435. And as we reprice the yield curve lower, the dollar is weaker against the euro at 108.62, positive by 0.4% on that currency pair. And dollar yen down to about 155. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.